And we're live. Excellent. Thank you. So this is the 1-year anniversary or celebration, the catch-up meeting since Rebel Finance School 2022. It's exactly a year ago. Well, it was a year ago yesterday, wasn't it?
I feel like we should cheer. Should we do a little cheer?
Definitely.
Yay!
Well done. You've survived the year.
Happy birthday to us.
Happy birthday to us. Happy birthday to all of you.
And it was yesterday, that would have been a year, but we are currently running Rebel Finance School 2023. So I know that Monday night is normally finance night, but we've gone a little bit crazy. And Tuesday night
is finance night.
Unless you're watching on catch up, then obviously feel free to watch it on a Monday.
Exactly. So we had an opening question, which is an interesting question to ask. Are you pleased with your progress? Are you happy looking like Katie, or do you look a little bit like me going like, what's happened in the last year? And Katie has a poll for everyone on Zoom. People in the room can tell us. Tony Ward says, yes, definitely. I love the positivity. But please answer the poll.
Yeah,
tell us what you think.
Scale of 1 to 5. So a 1, I'm really disappointed, frustrated with what's happened. All the way up to 5, I'm flying, baby. I love the progress I have made.
And everything in between.
If you're watching
really want to know.
On catch up on YouTube, maybe put a little comment saying what number you are and why.
Yes, so vote now. And I don't know why Katie put the vote logo over her mouth. I'm really not sure about that.
It felt right.
Felt right.
So the votes are pouring in. I'm going to leave it for a couple more seconds, and then I am going to end the poll and see where we are.
Collier says, it's given me confidence and empowerment. I love that. If you had 2 emotions to take into the next year, those would be very good emotions to take with you, confidence and empowerment.
I like those emotions.
Give us the results,
so
Katie. What did people say?
A few people are at the low end of the scale, so saying like really disappointed, frustrated what's happened. So we got a 1 and a couple of 2s. And then most people are sort of the other side. So we've got
27% in the middle.
Yeah, just under half of people are a 4, and then about a quarter of people are a 5. So the purpose of today is to celebrate any progress you have potentially made, and to help you and to encourage you if you are further down that scale, if you're a 1 or a 2 and you're thinking like, what's happened, like frustrated, life happens or whatever's happened, or maybe we haven't given you everything that you need to be able to progress. So that's the purpose of today, is to take stock and say, okay, what can we do to move forward from now?
Because everyone overestimates what they can achieve in a year. They think, I'm going to fix my entire finances. I'll retire by this time next year, Rodney. It'll all be done. Everything will be okay.
Was that an Only Fools and Horses reference?
It was an Only Fools and Horses reference. They happen occasionally. However, most people underestimate what they can achieve in a decade. So we've had a year, and that's incredible. But what tends to happen is people go, I haven't made the progress I wanted in a year, and then they start to give up. Whereas if they just kept going at that pace, it's incredible what you can achieve in multiple years. So in a decade, it's amazing. And it was actually about a decade for us from the time we really started to get on top of our finances to getting to financial independence where we wanted to get to. We laid a lot of the groundwork before that, but it is incredible what you can achieve in a decade. We did have one other question to ask you right at the start. We wanted to know, have you been attending any of the Rebel Finance School 2023 sessions? So Peter's saying yes, yes, Judith's saying yes, Dom's yes, Tahir is saying yes, no in the middle. That's okay, you don't have to. I'm just curious. We just wanted to know. Jennifer says yes, Chris says yes. We just were really curious because we spent a lot of time updating the course this year. The first time we ran the course, we spent a huge amount of time developing the outline. And then the second year we ran the course, I was like, this will be easy because we've already written it. And then we spent almost the same amount of time improving it. And then the third year I thought, okay, like now it's really good. It'll be really easy to run it this year. We ran it the third year, and then Katie created a retirement calculator. We wrote and developed the notes. We spent even longer improving it the third year. And then this is the fourth year we're running now. And we both thought, we've done it now. The course is as good as it's going to get. But then we rewrote huge sections of it again. We redesigned the slides, we created new notes. It's amazing the amount of, you can keep improving it every single year. You never stop. And Sally May says, yes, it's a brilliant upgrade, which I'm very happy about.
I wonder if our progress has been linear.
I don't know if it's been linear.
It's not linear, Alan.
We'll come on to that. We'll come on to that. So share the results, Katie. It is a trap.
So about 41% have been coming to all sessions, which is very exciting.
Which is amazing.
Course, about 25%, so a quarter of people have dropped in on a couple, and then a third said no, they haven't come. So hopefully that meant they got everything that they needed last year.
I love that. So we wanted to talk to you a bit, first off, about the roller coaster of the stock market, because it is a roller coaster, and it has been a roller coaster 18 months. Since the last Rebel Finance School, all sorts of stuff has happened. We've had high inflation, we've had Russia invading the Ukraine, we've had all sorts of things. And we said to you in the course last year, we said, the stock market always goes up. That's what we said. Did it go up the year? Did it go up last year? It's interesting, isn't it? Because everyone says investing in the stock market is risky. And actually, on average, the stock market goes down 1 in every 3 years. So 1 out of every 3 years, it does go down. So how can we claim that the stock market always goes up if it actually goes down 1 of every 3 years? So I obviously downloaded the chart for one of the funds we talk about a lot on the course.
I like charts.
Katie loves charts. This is the FTSE Developed World ex-UK, which we've talked about lots. Hopefully, if you were here last year, you know that fund. You at least know we've mentioned it. And you can see this here, this bit right at the top here, is December 2021.
All those heady days.
The heady days. It was the height of the market. And then what happened over the year? This here is December 2022. So over that year, sorry, December 2022, yeah. So over that year, if you took those 2 points, the market actually went down. It's one of those 1 in 3 years. And this is because we have arbitrary dates of December to December, like the calendar year. But it's one of those 1 in 3 years where it went down. And then since January, what we've actually seen is a reasonable climb back out. And I don't know if any of you still do your monthly finance meetings. Pete's nodding, which he gets a gold star for sitting at the front. We have nods. I love this. Are people online nodding, Katie? I can't see everyone.
I can't see their faces.
Helen's nodding. I love that. She actually rapidly nodded with the whole camera.
She used the camera to nod.
She nodded with everything.
It's interesting as well, because if you look at the sort of the calendar year to today, which is what we're doing today to celebrate a year since finishing the course, actually it has gone up, hasn't it?
Well, where is it, like July, somewhere in there? So if you took the calendar year from the course, it would be about here, and it's actually been quite a nice bit. So if you had invested right at the point we ran the course, you would have seen a really good growth, which is quite interesting. But this is just all timing the market. And what we've got here is we've just got 18 months. That's all we're looking at. So if you actually zoom out, this little bit at the top here was where we were just looking at. So this now is from 2011, because that's like roughly when the fund started. But you can see it's more or less been a march all the way up ever since. And when we talk about the market always goes up, what we talk about is over the long term, not over the short term, because sometimes it dips. The fascinating bit, like, look at the size of the COVID little bit there. Do you remember when that happened and stocks and shares were crashing and the whole world was on fire and everyone was panicking? How does it look on that chart now? Like, it's barely a dip, is it? You just look at it and you go, it's like, sorry? It's still scary. It's kind of a little one though.
All you needed was a little bridge, and then you could just cross over.
Just go straight across, and it's interesting. Carla says, can we look at the FTSE Global All Cap performance, please? I haven't got the charts for that one up, but we can have a look later.
We can have a look later. They'll all be broadly the same, because the amount of overlap between the two funds is very high, but yeah, it would be interesting to look and see. I'm
They're
expecting
70% the same
extremely
companies.
similar.
Yeah, and it's fascinating. So what we've had over the last year is a bumpy ride, and that's what happens in the stock market, is you get a bumpy ride. And lots of people say to us, the market's really unstable right now. I should wait until it becomes stable to invest. I love that. Pete's looking at me horrified that I've even said those words. They're not my words, it's okay. This is what people say to me regularly. It's like, I should wait until the stock market is stable. Is the stock market ever stable? Does it ever, Lauren immediately put no, it doesn't ever become stable because there is always something happen. There's always, this market's going up, this deal's happening, these companies are moving, this happens in the world. The market is never stable. So people use this as an excuse not to invest, or actually it's their fear. Like they have the fear, like, oh, it's not stable, I shouldn't invest. But the thing is, it will never be stable. Yeah. Kate Goldthorpe says, heard those exact words today. It's very volatile right now. The really interesting thing is there's never been a time in history when it's not volatile.
Yeah, you could delete the last two words, couldn't you? Say it's very volatile. Yes, that is, what do they say? It's a feature, not a bug. It's part of the thing. I see we have some software engineers in the audience.
But it's like the price of admission. The price of admission to earning money in the stock market is you dealing with volatility. If you can deal with the volatility, you get to play the game, and over the long term, you will do really well. If you can't deal with the volatility, you will not invest your money, you will pull it out at the wrong time, you'll do daft things, and it will crush your financial future.
Brownie points for Dom. He's put a graph in the chat for the FTSE Global All Cap over the last year. So you can see
definitely get 10 points there, Dom. Awesome. People also say to us, the market's too high. So you've actually seen it going back up over the last 6 months, and now people are going, well, I've missed opportunity. I should wait for it to go back down again before I invest. Will it ever go back down again? Maybe, but over the long term, the answer is no. Like maybe it'll crash, maybe it won't, maybe it'll just surge up. But we cannot know that.
Look on my screen, I've got the chat here.
I love that. So the question is, Katie,
what's generally considered long term? I'm around 8 to 10 years to my retirement date. I want to take more volatility and change some of my funds to reflect this. My company pension assumes I want lower risks in the last 10 years to retirement. So like now, because Collier said it's around 8 to 10 years to retirement.
Well, I think let's deal with the first one.
Yes.
What everyone says to us is, it's all right for you. You've got 30 years to retirement. I retire in 8 to 10 years, so this strategy doesn't work for me because I only have 8 to 10 years left. What I always say to those people is, are you expecting to die at the point you retire? I'm assuming not. I'm assuming they're going to like live a bit longer.
There's going to be a long, happy retirement that's very fruitful and happy.
Yeah, Collier, are you expecting to die in 8 to 10 years? I'm hoping she says no. I'm really hoping. I'm gambling on this one. But the point is, your investment time horizon is not just until you retire, it's your entire life. So you might retire in 8 to 10 years, but most people have a 20 or 30 year retirement. So your investing time horizon is 20, 30, maybe even longer, depending on how healthy you are. Collier, thank God she put no exclamation mark, all caps. I'm suddenly feeling a lot better. Thank you for replying.
We're saying she. I don't know if what gender they are.
No, they. But does that make sense? Everyone confuses that and goes, my time horizon is just until I retire. It's not. It's many years afterwards. And even then you could go, are you planning? Some of us are planning on spending all our money before we go. Some people are planning on handing it to their kids. And you go, well, then your investment time horizon is not until your death. It's like all the way through to the next generation. And it gets really fascinating when you start to look at it as a longer term game rather than something that just ends. So when people say the market's too high, I just go, what are you doing? No, it's not. It's always going to be higher over the long term. We just have to get on it.
I'm just going to put a link in the chat to a video that we made that answers this question, because people always ask us, am I too old to invest? Is it too late for me? And we get that so many times that we thought, let's make a video.
We made a specific video to answer that
so
question.
So I've just put that in the chat on Zoom, and I will update the YouTube description with that as well.
But it just says no.
Judith, you've stolen the punchline, because actually what happens is Alan goes, am I too old to invest? And we just go, no. End video. No, it's a bit longer to it, but yes.
We're having fun.
The
anyway.
answer is no.
And then people say the market's too low. They're like, oh, it's down. And it's almost as if they're Goldilocks. The market's too low, the market's too high, the market's unstable. Like, it will never be exactly what you want it to be. You just have to get going.
Well, often it's the same person that's saying this as well. It's like, it's too unstable, it's too high, it's too low, which I think is reflective more of their fears and not kind of understanding how the stock market works, rather than actually thinking that. I think they're looking for reassurance, as like, well, now's not the right time, is it? Is really what they're saying, because of the fear of starting.
So the question...
Anand says you're supposed to buy low and sell high.
We would call that timing the market, because you can never know what low is. The only thing we do is, if we see it crash, we go, what money do we have under the couch? What cash do we have? Because generally the rule is, if you have spare cash, get it invested as quickly as possible.
Assuming you're ready to invest.
Assuming you're ready to invest and you have an emergency fund and you're all set up. Get it in as quickly as possible, because time in the market is more important than timing the market. So you can't wait for it to go low, because you just don't know when that is. No one knows when the bottom is. So which risk do you want to take? The question is, if you keep your money in cash, you are taking a guaranteed loss. Because inflation is 8% this year, it was 10% last year. You are guaranteeing you are losing money by keeping it in a bank, because a bank always pays less than inflation on its interest. That's just the way the game works, because they wouldn't make money if they paid more than inflation. So they take your money and they pay you less. So what would you like to do? Would you like to guarantee your loss and keep it in cash, or would you like to invest it and see if we can make some money? It's an interesting question.
Which we've talked a lot as well about risk versus volatility. So, and the finance industry has confused the two. So when they say, oh, how much risk do you want to take? What they actually mean is how much volatility, meaning how much does it change in price over time? Whereas I think of risk, what we really mean when we say risk is like the risk of losing money, the risk of not having as much as when you started, or the risk of it going to zero, all these fears that we have. But actually, if you're investing over the long term in the stock market, the risk of losing money is extremely low. And Collier had that question, well, what does long term mean? We're investing for the rest of our lives. This is decades. So even if you are older, you still have decades, or if you're planning on passing it on to children or whoever you want it to inherit it, that is decades, that is the long term, and the risk over that time period is extremely low, versus the risk of not doing that, of keeping it all in cash because you're afraid of what might happen with volatility, and then it will absolutely be worth less. It will still have the same monetary amount, of course, or a little bit more because of the interest that you've earned potentially in the bank account, but its buying power, meaning how much it can buy over time due to inflation, prices going up, is gone down.
One key thing which I think has come up a few times as well, which I really think is important for everyone listening to this, is the time frame doesn't mean the time frame before you live off it.
Yes.
It just means the time you're investing it. So you could, like, as the most extreme example I can think of, you had £1 million in cash, you've been keeping it under your bed and worried about it. You could invest that in the stock market today and then start to live off 4% of it straight away, because the money will stay invested over the long term. So it's not the time until you use it, it's just the time it will be there. Does that kind of make sense to you? There's a furrowed brow. So how do I explain that in a different way?
Imagine like you worked out that you needed £1 million to retire. And imagine if a magic fairy comes along and says, ding,
Here's £1 million.
Here's £1 million.
You never know. You win the lottery. Boris Johnson gives you $1 million. Who knows?
Boris Johnson. That's a very obscure reference.
It is a very obscure reference. Move on quickly.
So suddenly you have everything that you need to retire. You have enough money that you'll be able to live off that money for the rest of your life. If you invest it today, you can start living off it today. You have that money already. You have it invested, and it will be invested for the rest of your life. It's not like, oh, I have to have it invested for long enough until I retire. Does that make more sense? We've got a bit of a so-so.
Bit of a so-so. We'll keep going and we'll see if it doesn't. If it doesn't, we've got questions and we can explore this. Absolutely.
I think just a couple of questions that came up, or a comment from Valerie. I keep telling my other half to invest, but he is very, in capital letters, risk averse. With the amount he has, he would be a millionaire by now.
Which is interesting.
Yeah,
that's risk versus volatility again.
It is, definitely. And I just wanted to pick up on the language. I keep telling him to invest. So I wonder if there's sort of a better way of phrasing it, or having a conversation about, you know, what he's worried about, how it works.
Or just play him this bit about taking a guaranteed loss and see how he takes that.
That's true.
One.
That's true. What else have we got?
But this is kind of all based on the stock market will always go up, and we can explore why later. We can absolutely do that. But that's the general concept, is the stock market always goes up, and it has done for 100 and something years of its history. Hello, welcome to the front row.
Live humans, welcome.
The second question, Katie.
Christina said, is it 4% of that year's total, or is it 4% plus inflation of the amount at time of retirement? It allows for inflation.
Yes.
4% plus inflation.
I think it's made into an either or question, but it's not necessarily. So
are you saying it's not binary?
It's never binary. So the key is, when you retire, you get to live off 4% of it. And that 4% rule has inflation baked in. So it, like, historically, that's how they worked it out. But if inflation is the same, or like it keeps going on average like that, you will be able to live on, if you retire and you want 40 grand a year, next year you get 40 grand plus inflation. The year after you get the 40 grand plus inflation, and it keeps going. So it's kind of baked into the number. So you retire on your 40 grand a year, and then you get to spend 40 grand plus inflation each year afterwards. Otherwise, your money would go down in real values. And by the time you get to 80, you're like, well, 40 grand just buys me a Mars bar. This is not good enough. So it has inflation baked in.
So Christina asked a question saying, yes, but is it 4%, or it's Christina that asked the original question, but is it 4% of the original amount or 4% of the current year value? It's 4% of the original amount, isn't it?
It's 4% of the original amount, inflation adjusted. Yeah. So you would add inflation each year. The thing is, we tend to just keep an eye on it, because actually it tends to grow far faster than 4%. And we never recommend you just take 4% out each year and don't ever look at it. We say look at it, because quite often the stock market has grown so much faster than that, you actually have extra money to live off. So we just keep an eye on it and see what's happening. You obviously don't want to spend as much as you've got, because if it does crash, the idea is 4% is enough to absorb those crashes, and you can still live off a decent amount for the rest of your life. But keep an eye on it, because it does go up a lot faster than you could ever imagine.
Yeah, because the 4% guideline, we like to call it rather than rule, it relies on the fact, or assumes, that you will continue marching on spending 4% regardless of what's happening in the world. And if the market has crashed slightly, then maybe you would want to reduce your spending a little, because you don't want to withdraw as much to allow it time to rebound. So yeah, you would look at what's going on in the world. You wouldn't just like, la la la, I just spend my money without looking.
So that's sort of the key bit of the first bit, is the time in the market is more important than timing the market. We felt that was a really important message to come back to. Also, we had one person in the Facebook group from last year's course that basically said something along the lines of, shouldn't I get something that has better performance? They kind of said about their pensions, and like it hadn't done that well over the year, and they said, shouldn't I get something with better performance? What do you think my first question was? What is better performance? Well, I'm actually curious, like, what have you invested in? Like, that was my first question.
Oh, yeah, better than what?
Yeah, better than what? So this was the question in the Facebook group. So I just asked, well, what fund are you invested in? Like, that's the first question. He said the FTSE Global All Cap.
So he owns every single company that is possible to buy in the world?
So he did.
Publicly traded?
Yeah. So then my question is, what do you want to do differently? Do you want to start stock picking? Is that where you're heading? Because that's the basic next step, is try and improve on it, which is stock picking, which you all know the theme of the whole course was everyone thinks they can do better, but they never do. So we had a new scale that we've been thinking about this year to try and show this. So this is my stock picking scale for you all. At the far end, you've got one company. So you pick one oil company, you pick one gold mining company, as JL told us last year, his story. You pick Tesla, whatever it is, one company. That is gambling. Let me be very clear. You are gambling your future on one business that may or may not fail. We say avoid at all costs. You go up from that and you pick a small basket of companies, 12 companies. It's a little bit less risky because it's a little bit more diverse, and probably all 12 aren't going to go bust, but it's still not super secure, and you're picking. And picking is incredibly risky. So you go up a little bit further and you've got actively managed funds. They pick companies for you. They normally pick a whole fund of companies, but it's still picking. And it's a little bit more diverse. It's better, but it's still not great. And generally they charge you a lot for the privilege of picking. You avoid that. Go up a little bit further, and people have been saying to us in the group, they've been saying, America's not going to do well in the future. I should invest all my money in China. And they're picking one country. Is that a good idea? But you're still picking a lot of companies, but you're picking one country, and what's the risk? You could have picked Russia, or you could have picked Ukraine, or you could have picked some other country that has had real problems. So you could have picked the UK. That would have been probably the worst thing. But don't do that. And actually, this is what the Chancellor at the moment is trying to force us all to do, is to invest more of our money in the UK. Like, just don't do it. The UK has been doing very badly for the last 10 years based on Brexit and all sorts of things. Just buy it in the proportion it is in the world.
Which the FTSE Global All Cap Fund does for you automatically. You don't have to think about it. You don't have to think, oh, one country's doing better, I better buy more of them. No, it does that for you. That's the whole point of having that one fund.
Then you've got global ESG funds, which is the Environmental Sustainable Governance Funds. It's a mouthful to say, but basically it's more global, but it's still a form of stock picking. Because if you looked at the top 10 biggest companies in the UK, do you know how many of them have been stricken from the ESG
stricken,
fund?
That's very dramatic. I love it.
Yeah, stricken. How many have been removed? Do you know? Does anyone know on there? The people who were watching last night know the answer. It was 7. So 7 out of the top 10. So basically with this fund, you're removing 7 of the most profitable companies in the UK from your index fund. Is that good for your performance? Probably not. And it depends on what you think, but one of them is Diageo. They produce alcohol, Guinness. I've got nothing about, I don't really care. Like, if you want to drink alcohol, go ahead. Like, it doesn't really affect me. So I don't want that removed from the index. I don't drink personally, but I know other people do.
Yeah, it's kind of based on someone else's morals. Like, we all have different ideas about what is ethical. You can look here. Oh.
What did Ella say? Please, could you say something about the risk of having all your pensions and other investments with the same platform provider, e.g. Interactive Investor? Yes, Ella, we can, just in a moment. The final part of this one is the Global Total Market Index is the furthest along that scale, because you're not picking anything, you just buy the entire market in the proportions that it exists. You're buying every industry, every company, every country. You just don't pick. And that's the kind of purest version of index investing. And it gives you average results. And it turns out average results are way better than most people's results.
Because it's the average of the companies, it's the average return of all these different companies. It's not the average returns. It's not saying you're an above average investor, you're a below average investor. You can just have average. No, it's the average of all the companies. It's not judging you as a human and your ability to have money.
There was a fascinating stat that came out that 80% of actively managed funds last year failed to get the average results. Like they were lower than average. And you think, well, how does that work? How are 80% below average? Well, it's 80% of the investors, not the results. So actually, average results is better than nearly everyone out there. And in the investing world, I would take average every day. It is amazing. And we have taken average for the last however many years.
You accepted average in our marriage?
No, in our investing, I accepted average. I accepted average in our investing, and it's done incredibly well. And then people go, but I'm clever. Shouldn't I try and get better results? Pete's laughing. Do you think you should try harder if you're clever? Should you try harder? Try smarter. Should you work smarter and harder? Well, the interesting thing, my answer is no, don't do that. Because it generally ends up in you getting worse results. The more you screw around with your investments, the more you choose countries, the more you choose individual companies, on average, the worse results you get.
Before you go into the next bit, we've had a question that's kind of been upvoted, so I thought we could maybe...
Oh, an upvoted question, I love it.
Sarah said, I need to transfer my old pension pot into Vanguard, buying the FTSE Global All Cap, but how do you pick the pension type? Any advice? First of all, we don't give advice, we give our opinion. Secondly, I'm not really sure what you mean the pension type.
So with Vanguard, there is only one pension type, so this will make it really easy. It's called a SIP, a self-invested personal pension. And you can take any of the other pension pots you have with previous employers and transfer them into one that you manage yourself. When you're inside Vanguard, you then have to choose what goes inside your pension pot, which is kind of baked into the question, which is the FTSE Global All Cap is the one this lady wants to choose. So that's it. It's really actually quite simple. And for everyone who's struggling with that stuff, opening SIPs, opening ISAs, we have filmed this week. I recorded myself with Katie opening a SIP and opening an ISA and investing our first £500 in a SIP and an ISA. So you can follow it step by step, and it will show you everything through those steps. Al, who is the building manager here at Rebel, is currently blanking out all my credit card details and account numbers so that we can put it on YouTube safely afterwards. Because this was actually us doing it. I don't trust everyone on YouTube. I may be naive, but I'm not that naive. Yes, the platform question, Katie. So what was the question, sorry? The question was just up here a little bit. Yeah. Please, could you say something about the risks of having all your pensions and other investments with the same platform provider, e.g. Interactive Investor?
Not naming names.
Let's just take the one we use just to make it like real that way. We invest through Halifax. Vanguard wasn't available to invest when we started. So we invest through Halifax into Vanguard index funds. And we currently have roughly £1.7 million invested in index funds with Halifax. So like that's the extreme example of what this lady is saying, isn't it? It's like, is your money protected? You have it all in one institution. Well, we got confident with this because if Vanguard failed, or hypothetically if Halifax failed, are they actually holding our cash? Where is our cash? Do you know where our cash is? In the market. What does in the market mean? It's been spread out. Yeah, so they've used it to buy stocks and shares. Christina says in the companies, that is exactly it. So they've used it to buy a share of those companies. So even if the middleman, Vanguard or Halifax, evaporates, I still own the company on the other side. Now, if every company in the world went bankrupt at the same time, we have larger problems than where my money is. That would be the end of the world stuff. But I've got comfortable with investing my money through one SIP, one ISA, because I know they don't actually have my money. I know what companies it's invested in, and if something ever did happen to Halifax in the middle or Vanguard in the middle, I can find, it'll be a pain in the neck, don't get me wrong, it's not going to be easy, but I could find those investments and I could go and get that money back. So that would, for me, gave me comfortable enough, confidence enough to be able to invest that way. Did that answer the question?
I think it did, but my opinion doesn't really.
No, I know. Who asked the question? Please tell us if it answered your question. So hopefully we did.
It was Ella.
Ella. So hopefully Ella says yes.
You want to pick up?
She can say no.
On another question before we carry on. So, any opinions on holding the FTSE All Cap and the FTSE Developed World ex-UK in the same wrapper? I know they're like 70% the same, but the FTSE Developed World is a little bit cheaper on fees, 0.09%.
Good knowledge on fees. I appreciate that, Gary.
And over the long term, with a substantial pot, this can make a difference because it's all about the fees. Gary's been listening. Gary's been listening.
It is all about the fees.
So for me, it's kind of pros and cons of different ones. So yes, the FTSE Developed World is a little bit cheaper, and you're right. Over time, that will have a difference on the performance, on the returns because of the fees. I think on the other side, the advantage of the FTSE Global All Cap is that includes more countries. So it's the emerging markets is the main difference between the two.
China, Brazil, India. It includes a whole bunch of countries that may or may not do well in the future.
So I think for me, it's all about simplicity, and it's just choosing one or the other, and either one is a good way to go, in my opinion. And so I don't think there's any real point holding both.
There's no real point holding both. The FTSE Global All Cap could theoretically do 0.09% better over the long run. We don't know. So it's kind of a gamble, and they're two pretty good options. So like, do whatever you want. It doesn't really matter in our mind. Just pick one and go for it.
I don't think it's a gamble. That's a bit strong.
That's not the right word. No. It's like, it doesn't really matter. You're picking the best of the two best options, and no one can know which one will perform better in the future.
And there's no point. And there's no point really looking at the past either, because some people might say, well, this one's done better than the other one. It's irrelevant. It's about what will happen in the future, and no one knows that, of course.
Exactly.
Shall we carry on with what we wanted to say and then come
yes,
back to
then
questions?
We'll come back to those. Absolutely.
Any harm in holding both, says Ashley? No.
No.
Like, there's no point really.
It's just kind of like, why would you hold both when they're 70% the same?
I just wanted to pick up on this as well. Claire said, isn't it max 375 for the fees a year anyway for Vanguard? That's two slightly different fees that you're looking at there. So the 375 is for the platform fees, and whereas the
fund fee,
it's the fund fee, the annual management charge, the amount that you get charged for holding the fund within it. And that's, you never kind of see that explicitly. It's reflected in the price of the units in the fund. So that's what Gary was getting at.
Perfect. Okay. Building on my don't try and improve your results bit, I just wanted to tell you about a study that Fidelity did about active versus passive. It's quite a famous one. But they looked at who got the best results over the long term, and they looked at all of their accounts to see who got the best results over the long term. Do you know who got the best results? There's nods in the middle. Yeah, there's a clue on the slide as well.
There's a clue on the slide.
The people who had the worst results were the active investors, the ones who danced in and out of the market, the ones who tweaked it, the ones who did things.
Tweaked or twerked, did you say?
Tweaked.
Tweaked, got you. Sorry.
We have none
of that.
My brain went something else
world. There.
Moving on quickly, people who forgot they had the account had excellent results, and the best investors were the dead ones because they didn't do anything. They didn't mess with it, they just left it. They couldn't mess with it, could they? They just left it for such a long time, and those were the best investors. So what am I trying to tell you? Just leave it alone. So this person in the Facebook group who goes like, I haven't got that great results over this year. Well, no one did. The market wasn't that amazing over this year. just leave it alone and it will grow over the future. So that's what we really wanted to say to you. I'm going to move on to the next little section. One of the things Katie and I realized this year, since last year's course, is we were helping people to become investors. And what we really realized was nearly everyone already is an investor. So if you have a job, you've probably been auto-enrolled in a pension. And if you've been auto-enrolled in a pension, you are an investor. But no one thinks of it that way. They don't see themselves as an investor. They just like, oh, I've got my company pension. So we came to the conclusion, if you said, no, you're not an investor, you're wrong, because most people of working age have jobs. And then we actually came to a very interesting bit of, are you accepting the defaults in the company pensions that you have got? So we'd like to ask you this. I think the answer, I'm hoping the answer for the people who've been on the course last year is going to be no, but I actually want to know. So Katie has a poll to launch. It says, are you blindly accepting the default? So that's what we want to know.
About understanding the funds that you're invested in with your employer. So the first one is, I've thoroughly reviewed and understood the options available to me, and I decided to invest in funds that weren't the default. I thoroughly reviewed and understood them and decided to invest in the default option. I picked some random funds that sounded interesting. I'm investing in...
That was several people on the call last year.
That was inspired by when I started working at Deloitte. There was a guy who was like, I had no clue how to invest. You enrolled in the company pension. And I was like, oh, what did you do, Mike? And he said, oh, I just ticked a bunch of boxes. Didn't really know. And I was like, okay, that's one strategy. I'm investing in a default fund, but I don't know what it is. And then also, maybe it's not applicable. Maybe you don't have a company pension and never have had one, which if you've worked for an employer at least recently and you've earned a reasonable amount, then that's also probably unlikely if you're in the UK. So I would start thinking, well, what are the pensions that companies I've worked for over the years, and like gathering up those different pots as well, isn't it?
Definitely. So the fascinating, share the results, Katie. 26% said I invested in the default fund and I have no idea what it is. Have you heard of Nest?
Are you going to go on a Nest bash?
Not totally, but pretty much. Nest are the sort of default government option for pensions in the UK. 8 million people have their pensions with Nest. That's 25% of the working population of the UK invest with Nest. What percentage of those people do you think accept the default option? 100 we had from the live audience. What do you think on Zoom? 99% said Lauren. She came on, must have come yesterday. It was 99% of people accept the default. And they're very proud of that at Nest.
Yeah, it's big front and center on their website. It's like, yes, our default option is so good that everyone has accepted it. I don't think they've accepted it. I think they've gone, okay, I'm ticking this box on a random form at work. I don't really understand what it is, but, you know, carry on.
Yes, so we did some research into what the Nest pensions actually invested in. Now, what's the general advice? When you're young, should you take more risk or less risk? More, the audience says. More, says Lauren. They've actually decided that for the first 5 years you're investing, no one can accept to see their money go down. So they have invested in you in secure investments, and their aim is to keep up with inflation for the first 5 years of your investment career. Do you know what those secure investments are? Any guesses? Any guesses on Zoom what they've been? Cash, it's not bonds, it's not cash. It's not those. Any guesses on Zoom? What, sweaters? Beige sweaters. It's almost as random as beige sweaters. They actually put front and center that they will invest you in wheat and gold. And you're like, what is this? A game of Settlers of Catan? I don't understand, Nest.
I know how geeky the audience
what are you
is.
doing?
So we got 1, 2, 3, 4, 5 laughs.
Hopefully the audience at home also liked my Settlers of Catan joke. But it's the most shocking thing ever what they're doing with pensions. I just want to say to the 25% of the people on this call are accepting the default. That's way better than the average in the population. However, if you've just accepted default, please check it, because you might be shocked at what they're doing with your money.
And we're not saying it's necessarily bad or not what we would do, but at least find out, at least understand what it's in.
Yes.
So yeah, we're not saying don't accept the default. We're saying check
what the default is. Because the default in your pension when you were at Deloitte was actually quite good.
It was very good, yeah. When we learned about investing, and I was like, oh, I'd better do and like go and check my company pension, see what it's invested in, and turned out it was already invested in a Vanguard Global Index fund. That was until they decided that they were going to change my fund to something else. That's a different story for another day. Or please watch the Deciphering a Fund Fact Sheet workshop.
Exactly, they just tried to force us into a different fund.
Yeah, so actually the default option, or the one that I'd happened to pick when I did my random ticking boxes, turned out to be a good one. So maybe, or in my opinion, it was good. So maybe it is already good, but it's something that you really need to check.
Yeah, Lauren says, I work in payroll and most clients choose Nest.
Yeah.
The Rebel Business School, the pension for all the staff members is actually a Nest one. The really interesting fact is, and I don't know why this is, but every team member that works at our company opted out of the company pension. I don't know why. And so we pay into their SIPs instead. Who knew why? But we have to have one. But everyone opted out, and we will never know why. Moving on quickly.
Lee says, am I right in thinking civil service pensions are not invested in funds? Does anyone know? So I assume when you say civil service pension, that will be a defined benefit pension, meaning that you get promised a certain amount in retirement for the rest of your life after you retire. I don't actually know. I assume
I would assume they're probably using current income to pay current pensions, and that's probably what they're doing, but I doubt we could find that out.
Those defined benefit pensions can be really good. So that's not to say that that's not good if they're not actually invested in something, because they guarantee that chunk of money, the annual payment or monthly payment for the rest of your life after you retire. Yeah, you could ask Lee, you could ask
Matt has answered.
HR how it works.
Matt has answered.
What did Matt say?
So it's quite interesting.
So Matt said some civil service pensions, depending on the scheme, are defined benefit pensions that are not based on investments, but are funded by contributions by scheme members, with any shortfall paid by the Treasury. So it's saying any contributions from people that are still working goes to pay towards the pensions of
the current ones,
the people that are retired, which is the same way that the state pension works in the UK. They have not invested some money and are going to pay it back to you once you retire. People that are still working are paying, when they pay their national insurance contributions, that's going towards paying for the people's pensions that are retired now.
I think that's how teachers' pensions work as well.
Yes.
Sarah said she thinks that's how teachers' pensions work as well.
I'm pretty sure it is, yeah. You've just got a defined benefit, so there's nothing actually you can mess with. There's no funds you can choose. You just get this much when you retire, that's it. This is like the private pensions that you go through.
Follow-up question from Lee. I pay a fixed percentage each month. Does that make it a fixed contribution pension? No, I think you've confused two things there. So because you're paying a fixed percentage each month, that's just what they ask from you to contribute towards the scheme. The it's like two different ends of it. It's like defined contribution is about how much you put in, and then it grows to whatever it grows to. Whereas the defined benefit is where
you contribute still, but you get a set amount at the end. So they're two different things. You're still contributing to a defined benefit one, but they say you will get £1,000 a month at retirement, or whatever the figure is. That's the bit you define. Whereas on the other one, you're defining your own contributions, because it's whatever you put in and it grows to whatever it grows to. Cool. Okay, so we're going to come back to a few more questions. We've got a few more bits to give you, and then we're going to move on. We just wanted to say, as always, the stock market will crash. At some point, it will crash. Expect it. It is not if, it is when it will crash. And a crash is defined as like a 20% drop, and it happens on average once every 8 years. That's the average. Sometimes you get two back to back. Sometimes you get none, like we had a bull run after 2008 for many, many years. And then you have a couple straight afterwards. Like, it's not a thing, but on average, every 8 years. So just expect it. And just to sort of show them, these are the last 4. That one was the dot-com bubble. I lost my life savings in that one. That was not a pleasant experience, but it taught me a valuable lesson. Then we had the 2008 financial crisis. COVID looks kind of tiny on that chart, doesn't it? It looks absolutely tiny on that one, but that was a crash. And here's our current one, which doesn't have a name at the moment. Who knows what we'll call it looking back.
Jeff?
The post-COVID crash, the inflation crash, what was that one?
Oh, I'm not going to repeat what Judith said. It involved a 4-letter word.
Exactly. So next bit, we had, hold on, Donegans. You tell me to diversify, but one fund isn't very diversified. We just wanted to say, when you buy an index fund, you are literally buying, if you buy the FTSE Global All Cap, you are buying almost every investable company in almost every investable country, in almost every investable industry in the world. Like, it's literally the most diversified thing you could do. So you might be buying one fund, but within that fund, you are in property, you are in real estate, there's companies that are involved in crypto. Like, you don't need to buy that, you just in the index. So it makes it really simple to do that. Next bit, which comes up an awful lot, is people say the Donegans are anti-property.
Yeah, they keep going on saying the house you live in is not an asset. People shouldn't be buying properties. People shouldn't, like, they should rent. They should never buy. What else do they say? You should never invest in a property. That's all sorts of things people say that they have, like, quite frankly, projected onto us. I've never said that. I've never said don't buy a home. If you want to buy a home to live in it, great. We're saying do the sums, do the maths. There's all these kind of mantras we have as a society.
Property always goes up.
Renting is throwing away your money. No, it isn't. You're paying someone for a service. You're paying someone to live in the property that they own.
Sometimes it's cheaper to rent than buy. Sometimes it's cheaper to buy than rent. Just do the maths. We are pro-maths.
We're pro-maths.
Not anti-property. Does that make sense to everyone? And we'd love you to be pro-maths. Like, just think about it, and then you can go, based on that maths, I'm going to make the decision to spend more because it's what I want. But you're doing it from a position of knowledge, not from a position of not knowing. And the not knowing bit, we had a lady on the first call this year, which we really wanted to highlight. And she came on and she said, I want to borrow money out of my current mortgage, which was like at 6 to 7% interest. And I want to use that money to buy an investment property. And my first question was, how much will the investment property return? And she said 3 to 4%. Can anyone see a problem with this logic? She's borrowing at a high interest rate to buy something that returns. So she's basically buying a loss. And it's fascinating, but people get so caught up in property is the way to go. I must own a property and rent it out, that they do crazy things to get it. Like, let's just remove the emotion, remove the fervor, and actually look at what's the maths behind it. So for Katie and I, it's all about the maths. And then we can figure out the emotion later. Hold on.
This probably made sense when the interest rate was like 1%, 1.5, and then you get your investment at 4%, then it's okay. But now the mortgage rates have gone to 6 to 7, so now it doesn't.
Would you ever accept a 4% return? Would any of you accept a 4% return? Do you think that's a good rate of return?
There's a gun stuck to my head.
There's a question, there's a gun stuck to my head. It's quite interesting. We would never accept a 4% rate of return. And actually we had that with our 2 investment properties. We paid off the mortgages. They were turning 15%. Then you paid off the mortgages, so we were no longer leveraged, which meant we had more money tied up in the properties, which mean the return on equity is lower. And they were 4%. And when we looked at them as a 4% return, we're like, well, the market on average gives you 10, 11%. Why would I ever accept a 4% return and work for it? That was the kicker. I'm working to get worse results.
Owning a property is
a business.
You have customers, the tenants, you have suppliers, the plumbers, electricians, whoever looks after it, you have to conform with all these regulations that the government has to look after the tenants. It's a business, it takes effort. We're not saying don't do it, we're saying go into it with your eyes open, with the return that you know, or that you estimate that you will get, because always things come up, and that the effort that's involved. We're not saying don't do it, we're saying go in understanding what you're getting involved in.
So we had a question from Ellie, who says, how do you work out what percentage return you make on a property? Katie is very excited because she designed a return on equity property calculator on our website. So she's going to put the link in the chat. If you want to work out what you're getting on your investment properties, use Katie's calculator. It has all the fields and it will crunch the numbers for you and give you the percentage return on equity, which is really important to look at the return on equity, not the return on investment. The equity bit is very important, and the calculator will explain why that is. But you need to know what return you'll get so you know whether it's a good investment or not. Most people never do the numbers. They can never answer that question.
Do you know how happy it makes me that I had a tool ready to answer that question?
It's amazing. It makes me happy too. Next little piece we just wanted to reinforce was the Donegans say don't buy a new iPhone. We don't. We say buy whatever you want, just know the cost. Do the maths, know the cost. So it's just one thing we want to get, because we get a lot of that. Oh, you know, I'm doing the Donegan thing by like not buying something that makes me really happy. I'm like, well, you've confused the whole point. The whole point is happiness. The whole point is to live your life exactly as you want to live it. Just know the cost of it and know I am sacrificing maybe a bit of freedom to have a new iPhone, and I'll work a little bit longer to get it. And if you're happy with that and you love your job, that's a great decision. If you hate your job, I would be making a different decision. But just know, make wise decisions based on what's actually going on with your money and your investments. So that kind of brings us to the end of this little bit of you overestimate what you can do in a year, but you underestimate what you can achieve in a decade. And I think we wanted to say to everyone, it's been a year since the course. That's not actually that long. And if you look at this is our net worth chart with Katie's favourite expression. Well, second favourite expression?
I mean, I don't like to compare pineapples when it comes to choosing my favourite expression. So thanks for making me.
That's okay. It's not linear. This is our net worth starting when I first started to work. Can you see does it even move off the bottom line for like the first decade? Like nothing has happened. And then you keep going, I've now been working for 15 years and it's slowly got off the line. It's like a flat line. My net worth was a flat line for 15 years. It was basically dead. Then we learned about investing. We started to buy a house, started to go up. Then we really learned about investing. We started to build businesses. The money started to go up. And then it just went crazy at the end. And
when you said build businesses, meaning your business took off, so you were earning more money to then be able to invest it.
Exactly. My business was taking off. Katie went contracting. The market was going up. Everything came together at the end. We had to do that like 15 years of hard work for it to start really taking off. And most of you are a long way down that route and you've already done most of this work. But we just wanted to say, if you don't see results immediately in a year, like you're probably not going to. You have to wait a little bit of time. It's not linear. It starts to take off at the end. Linear is where it's a straight line. Exponential is where it's like a flat line and then it kind of curves right up at the end. And that's what compounding does. So you get all the results in the last few years. That's where the magic happens. But you have to kind of go through that flat line and keep going and having faith, knowing that the maths proves that it will come towards the end. Okay, which then brings you on to a question. How do you keep going when it looks like nothing is happening? How do you hold the faith, Katie?
Hold the faith. So firstly, it's not linear, as we have drummed into you. And secondly, I would say, like, check that you're doing the basics, meaning are you spending your money consciously? Have you thought about how your gap between what you're spending and what you're earning and how you can make that as big as possible? Have you looked at what your company pensions are invested? Have you thought about how you can I haven't thought of another example, but like just get the basics solid, and like you're very welcome to come back to Rebel Finance School whenever you want, because as you know, we start right from the beginning of do you know where your money goes? How much money do you have? The importance of looking at what you believe about money, all those things to make sure
It's
that you're
the
still on
basics.
course.
And like, if you want the real basics, is how big is your gap? Like, can you increase your income? Can you reduce your expenses to create a bigger gap? And that's what we invest. And that's basically the game. That's the basics. Then you automate it. And then the key one is go and get on with your life, which actually came from one of the questions last year. I don't know if you remember Prabal.
Prabal, he was
From
always up
India,
at 3 o'clock in the morning
3
to
o'clock
listen.
in India, asking questions he's like, I've done all the work, everything's set up, and I'm really frustrated. What do I do now? I'm like, go and live your life. Go and kiss your wife, hug your kids, do something, and let compounding work in the background. That's the whole game. The idea is you are free to do what you actually want to do and live your life. That's what we want you to be able to do, is invest simply and then get on with the things that actually matter. I assume you like the person you're sat next to. Like, spend more time with them. They're lovely.
I got something else as well, which
Have you?
is, yes, before you move on, to fall in love with the process as well. If you're so focused on the outcome rather than what you're doing each day, each week, or each month to get there, then like, of course you'll give up, because you're not going to see results in the short term. So it's about falling in love with the process. We did a Rebel Finance School meetup in Birmingham, which was so much fun. Hello, Brummies. And
I have a picture. Obviously, there's the Birmingham meetup. There was like 20 of us who met up in the hotel.
So we met this couple, and the lady said to me, it's because of you that I have to do monthly finance meetings. That's the first thing she said to me. And I like, she was kind of joking, but she kind of wasn't. Like, she wasn't enjoying them. And to me, like, I look forward to our monthly finance meetings. That's like one of my favorite points in the month. So it's about finding joy in it, and how can you make it fun? And we talk about that in the course. I don't know if you remember. It's about like, how can you make it fun for you, your partner, for your friends, whoever you're doing your monthly finance meeting with? Make it an enjoyable part of the process. This isn't about pain until some payoff in 25, 30 years. This is about enjoying the process.
Have fun along the way.
Talking of fun.
We
scurried off.
One question from Sally May, which was, is it better to lump sum invest or put your money in monthly? And then someone put lump sum Sally, which made me laugh, because I thought it was like early Ellie and late Larry, and you've got lump sum Sally, which just made me smile massively. But the answer to the question is lump sum investing wins every time. If you've got 10 grand, don't put it in £1,000 a month. That's daft. You will lose, because the market always goes up. So put it all in one go, which takes some guts. And the math stands no matter the amount. Like, you say, well, what if it's 100 grand? Should I dollar cost average or invest in lump sum? Well, the amount doesn't change it. Just put it all in one go. What if it's $250,000? Same answer, all in one go. What if it's £1 million? I'd be really scared. Same answer. Maths is maths. The number doesn't matter. We actually did it with £250,000. We were scared to invest the money for like a year, because Brexit was happening, because Donald Trump might get in America. We were like, the market will crash, the dollar's high. We had all these excuses for getting on with it, and we missed out a huge amount of growth, and it cost us a fortune. And then we went and learned from some of the best people in the world, and they said, just get on with and doing it. We did it the next day. And since we did it once, we now have become slightly Vulcan, and we're able to do it without emotion. But the first time, it's a bit scary. We've been there, but lump sum investing wins every time. Just get on with it. Cool. Rant over.
Speaking of having fun along the way, since we ran Rebel Finance School last year, we have been busy making all sorts of different resources for you. So we've had not one but 2 YouTube series come out in the last year,
which Derek helped us make. Thank you, Derek.
We've improved the course notes. There's plenty of articles, and then yesterday was week 7 of Rebel Finance School 2023, and we had Brad Barrett on, who is founder of Choose FI, which is the biggest financial independence podcast in the world. So like, check
if you
that
want
one
to
out.
watch
Yeah.
that one, like there's lots of things we've been producing if you haven't stayed in touch that you are welcome to use to help with the confidence of doing this stuff and to help you on the journey.
And actually, one of the questions that we had when we asked what questions do you have for tonight, one lady said, I just can't talk to my husband about this stuff. He's not interested. He doesn't want to know. So we made that video that's top left there called
Let's talk about money, how to talk about money.
Yeah, with your partner. And there's an article that goes alongside that as well. So that's something that we've done for you because it's a question that we get asked all the time.
And as we've been in the UK for 2 whole months, we've been doing meetups around the country. This was the Bristol meetup where like 20 people came and we sat outside. It was wonderful. This was the Birmingham meetup. We've got a few more planned. We're going to be in Henley upon Thames. We're planning one in Reading, and then afterwards we're going to Poland. So if you happen to be in Poland, come and hang out with us in Poznan. And that QR code has all of the places we're going to hang out with different people, or just my website /events.
Christina says New York, please.
New York, Christina, we were actually looking up prices of New York hotels yesterday. Funny you should say that. It was expensive.
We decided against
Yeah, we will come. I love New York. But what we really wanted to say is don't wait for us. Just organise one yourself. Put it in the Rebel Finance School group and say to people, I'm going to come here. Whoever wants to come and hang out. That first one we ran in Bristol, Katie and I picked a table of 4 because we didn't know if anyone would show up. So we had 2 seats thinking maybe a couple will show up, maybe 2 people will show up. And we took over half the place. It was amazing. So just like the worst that happens if you go with a friend is the 2 of you have a nice chat and no one shows up. The best that happens is you make 4 new friends. So just don't wait for us.
We actually took our laptops as well, so we could.
We were doing work when everyone arrived. We were like, just in case we've got something to do.
Heaven forbid we should talk to each other. That would have been crazy. Right, what's next?
So next up is your thing, Katie.
My thing.
Well, it's not your thing, it's our thing.
Yes. So we want to know how you've been getting on. That's like, we've gathered here. That sounded very.
We've gathered here today
to understand what problems you've had when it comes to your money. What things have gone well? What things do you feel like are still stopping you? How can we continue to support you? So we have made this survey to understand that. And what we would ask of you, please, is to fill this in so that we can understand all those things, where you are, where you've got to, what didn't quite make sense, what do we need to give you more on, any other resources that you think we could provide that would help you. So this is something that we ask of you to help us to make the course better and to understand how to help you better.
And to help the next people, because your experience will help us improve things for the next set of people. So it's really valuable what you tell us, and we read every one, we go through it, and it helps us to refine the course. Abby just put an amazing comment.
Put a list of 10 things. That,
reflections on what you helped me over the past year. Tracked my spendings and earnings. Know my net worth. Fired my financial advisor who was charging me 1%. Awesome. Took my funds in Quilter away from actively managed. Like, wow. Abby, will you put that in the 1-year survey? You get a huge round of applause for that. Billy, we'll answer your question in a second. We'll come on to that. Just before, we're going to quit out the slides in a second. I just have one last thing to say to you all, like in the bit where I'm talking, which is, if you want the same results as everyone else, do the same as everyone else. That's the simple answer. If you look at everyone else around you, just copy them and you'll get the same results. The tragic thing is, doing normal things brings bad results. How are most people's financial lives? Like something like 70% of the UK has less than 10 grand in savings. You know, like, how are you saving for retirement? That is not going to pay for your tea and coffee in retirement or turning the heating on in winter. And there's some shocking stat that 1/4 of people are heading towards poverty in retirement. Like, if you want normal results, do normal things and it will bring very bad results. The fascinating thing is, if you try a little bit harder and you do good things, that will get you like average results, which is still not very good. If you want different results, You need to do something different. This is the most disturbing picture I took today for the slides.
Yeah, I'm not as attracted to you right now.
If you want different results, do something different. If you want extraordinary results, do extraordinary things. Like, who spends their Tuesday night on a finance course learning about stuff?
Me.
There is something extraordinary about that. Who goes on a 10-week finance course? Who takes the action to fire their financial advisor and learn to do it themselves? That's extraordinary. If you do extraordinary things, you will get extraordinary results. If you do the same as everyone else, you will get the same results as everyone else. And that's what we really, really wanted to tell you. So we're going to shut up and take all your questions from Zoom and things. The one thing we would say is, please do the 1-year survey for us. Like, we don't ask any money for the course. We don't ask anything. The only thing we want is to know, did it work? That's it. So please would you put like a note in the chat? Say yes if you're going to do the 1-year survey for us. Please say yes. And if you're in the room, please say yes if you're going to do the 1-year survey. Okay, we've got a nod. Yes, Tahir's doing it. Perfect.
Bibiana said yes on YouTube.
Bibiana says yes.
Yes,
Fiona said yes.
Compelling yeses.
Okay.
It went so fast that if someone said no, it would have.
Someone
slipped
said
through
doing
the
it
gaps.
now.
Yes.
Sally May says goes without saying. Love you, Sally May. You're amazing. Lump Sum Sally is doing it right now. That just made my day. I'm sorry.
Yeah, we've got a lot of yeses. Thank you. We look forward to reading what you say.
Yes, we do. So we will quit out of the slides. We put the link in the chat, and if you're on the YouTube, the link is in the YouTube description as well, so you can get that.
We'll also send a follow-up email tomorrow with the link to the survey as well. Actually,
Lauren says, I will fill it in if you answer my email.
Oh.
Lauren, can you send it to me again so it's at the top of the list, please? And then I will answer it. I try and answer as many of the emails you send me as possible. Sometimes I get behind and they just get lost. And when I'm running Rebel Finance School, I get sort of 30 emails a day about financial questions. And some of them are very long and I just can't answer them all. I can't keep up. So I try. If I haven't, please accept my apologies and send it again. It doesn't mean I don't love you, Lauren, or anyone else there. I still love you, and I will do my best to answer as many as possible. Excellent. Okay, right. We are free of this stuff.
Yes, let's pin us. Can we pin us?
Can you pin us, please?
Spotlight, sorry. Can
Spotlight
you spotlight us?
Okay, so
we had some questions come through on emails that I'd like to cover off a couple of those.
Should we do one email and then one live?
Okay.
Let's do one email and then one live. Let's go for it.
So
we got 3 on Zoom as well. Yeah, that's the live ones. Perfect.
So we had a question from Bella, and Bella said, I am not the same Bella that is always first to put my hand up in Rebel Finance School 23. So
if you've been watching this year,
Bella.
Bella is always the first person to answer a question. She is on it.
She is a keen bean. So Bella says, I'm planning to set up a SIP. I'm aware that you can put in whatever your salary is, like as the maximum. I work both as an employee at a company and I'm also self-employed and complete a yearly tax form. So say I earn 15k in my job and 20k self-employed, does that mean I can put 35k in each year into a SIP? So the thing to think about, Bella, is that you have to allow for any potential employer contributions as well. So the total 35k is all contributions. So if your employer
is matching what you put in,
yeah, you have to allow for that.
But the basic answer is yes. It's both of those numbers,
yes.
But it's also like, how much did your employer contribute? So we just need to be a little bit careful with that and do the sums.
Yes.
I love that. It was an easy one.
And Bella also had another question. There was a news article recently that the Telegraph did this investigation, and it found that one platform was allowing investors to buy fractional shares in ISAs, and HMRC, the tax authority in the UK, said that's not allowed, and caused a bit of panic. What they're talking about is buying fractional shares, so part of a share in US companies. That is not allowed according to HMRC, and I think there's ongoing kind of discussions
about whether it
that.
should be allowed.
So it was with a particular platform or a few different platforms
Called free trade.
If
That was the
you're
one.
if you're buying index funds,
Doesn't
like
count.
it doesn't, you're fine.
You can buy fractional shares of an index fund and it is fine. So it doesn't apply to what we've been talking about here. It's something completely different. But sometimes these news articles panic us a bit. So you are fine. Excellent.
Just to add to
Oh,
that,
hold on, let's give you the microphone.
Perfect.
We have a comment in the live audience.
Live audience comment.
So just to add to that, free trade lets you buy shares, but you do not own the shares. They rent out the shares to other companies, so you need to be careful about that.
Okay.
Yes, it sounds like just avoid free trade.
Other companies
Hold it
also
to
do
your mouth.
it.
Yeah,
So,
it's a fairly standard practice, but not one that we would recommend. Thank you very much.
Not that we give recommendations.
No, we just move on quick.
Bibiana, I'm going to go for a what I consider quite an easy question. How do we choose where to travel next?
Bibiana asks, how do we choose where to travel next? I love it. It's a non-investing question.
I love it.
Generally, it's like what country looks cool.
Yeah.
And I normally scroll around Google Maps. And when we were in South America, I was scrolling around Google Maps and I found a town called Montevideo. And I was like, that sounds like the coolest place ever. Let's go there, just based on the name. And I looked it up. But we generally just look like, oh, I've never been to Brazil. I really want to go to Brazil. Let's go there. I really want to go to India. That's on our target list. But it's generally like the places that excite us, and you hear things, you read articles, you look for places. And I do love scrolling around the map going, where have I not been yet?
Should we do one of the Zoom questions?
Yes,
and we
please.
can go back to the questions that people sent.
So we have Trusha. Hello, Trusha. Are you able to unmute and say hello?
Hi, can you hear me?
Yes.
Hi, how are you?
I'm fine. Thank you so much again. Two really quick questions. The first one, when you said, Alan, that you lost all your life savings on the dot-com bubble, is that because you sold your shares, and if you'd kept them, you would have been okay now? And the second one.
Can I answer that one first?
Yeah.
Oh, no. So if my life savings had been invested in an index fund and I had just kept them, it would have gone back up. But it was not invested in an index fund. It was invested in an actively managed fund that was high tech and high growth.
Right. Okay, I got you.
The worst possible fund. It went from, like, my life savings at that point was enough for a house deposit. It was like £7,000. I was 20 years old. It was everything I'd ever made. And it went down to £1,200. And I kept it for about another 5 years, and it made it back up to £1,400. So whilst I held, it was an actively managed fund. So the people within the fund did not hold. They were trading within the fund. So it's really fascinating. You can hold with an actively managed fund, but that doesn't actually mean they will. So that's like one of the reasons that scared me off investing in the stock market for like 14 years. And it was only when I actually learned the difference and why it failed that I found the confidence to be able to start investing again. Did I answer that okay?
Yeah, no, because I was confused. I always thought you'd had it in index funds. So I was like, oh, what? Yeah, I get
I
you
bought
now.
into the suit and the fancy car, and my dad said, here's my financial advisor. You can trust this man. Look, he drives a soft top and has a suit. And I was like, yes, I'm young. I will believe the suited man.
Thank you for answering that one. And then the second one is, am I right with the Vanguard Global All Fund accumulation? I always thought every year I'd end up with more shares, but I don't, do I? It's just the share value goes up.
Yes.
Yeah.
Yeah, they don't give you extra units. It's allowed for in the price throughout the year.
So so in like 15, 19 years time, when I'm ready to retire, the share value should have gone up because the stock market always goes up. And then that's what I'm selling off at a much better rate than what I bought them for.
The units, yes.
The unit, yeah.
The units in the index fund.
Yeah.
Dom had something to add. What you got, Dom?
Yes, the way to be able to see that is if you compare the distribution fund versus the accumulation fund and look at the price increases on them, you'll see the accumulation fund price increases or decreases faster than the distribution fund.
So Dom's using slightly different language to the accumulation. It's a great point. So you've got the accumulation fund and the income fund is what they call the two. So if you look at the two same funds, you can actually track to see how much the accumulation fund goes up quicker than the income fund. So you can actually see the difference of how it works, because they're identical funds underneath. It's just how the dividends are treated differently. So you can actually compare the charts and have a look if you'd like to. But the short answer is, yeah, you have the same number of units. They will just be worth a lot more.
Brilliant.
Excellent.
Perfect.
Thanks, Prasha.
Thank
It
you.
was lovely to see you.
Yeah,
We're
you
looking
too,
down here
guys.
'cause you're on this screen.
Yeah, if it looks like we're not looking at you, it's because the face is there, but the camera is there.
Cool. Awesome.
Thanks, Prasha.
Bye-bye.
Bye.
Bye.
Should we go to Christina next?
Christina next. And like, if you're in the room and you want to ask a question as well, you are allowed to. You can just wave at us and we'll pass you the microphone. Excellent. Christina, is this Christina who comments on all our YouTube videos that I love massively?
Christina's so positive
She's
and
the most
lovely.
positive
She's
person.
like-
We love you for commenting on all our
Oh,
videos.
thank you. You guys deserve it. You are so kind and caring and generous with your time, and even into your 3-hour questions. You guys are amazing. So thank you. I have a philosophical question for you, and it's okay if you need to think about it for a bit first. So we have 5-year-old twins, and we've just begun our own financial independence journey. We follow Choose a Fi and the Jensens, and I don't know if you know or have been following with Mindy and Carl Jensen, and they just did that big interview with Ramit Sethi talking about their money mindset and how they have such a scarcity mindset, and kind of changing that viewpoint from I can't spend to like, well, when is it okay to spend? So we've started with our kids. We give them like an allowance, like 10 quarters, 10 pennies, whatever. And we're telling them 4, you have to put in the investment part. 3 is to spend on whatever you want. 2 is to save for something later. And 1 is to give. We have a little poem that goes with that. We have a little book that we wrote that's getting illustrated for little kids. So that's basically 50% to spend, right? 30% that you can spend now, 20% that you're saving to spend on something later. And I really felt very secure in that. You know, that's what JL Collins did. But now I'm wondering, am I kind of pushing a mindset on them that is going to hurt them in the future? Except you kind of need that mindset in the beginning so that you can get to the point where you have your big nest egg to spend. So I was just curious what your thoughts were, if I'm kind of, I know you struggle with that too, Katie. So I don't struggle with spending. I spend way too much. So I didn't know if you had a philosophical thought on that. There's kind of a mindset shift happening in the financial independence community. So
I guess my initial reaction is like, well, what's the alternative? You're going to encourage them to spend everything and borrow more from each other and go into debt.
right.
So it's interesting, and even within the same family, your kids are probably going to react differently to it. I don't know if you've already experienced that. So I've got 2 older brothers. My eldest brother would probably like spend everything all in one go. I saved everything, and the middle brother was somewhere in between. He would like eke it out, but he would eventually spend it as well. So
And they were brought up by the same parents.
we're in the same family. I mean, obviously our parents were different as they aged in the birth order and all that stuff. I think one of the things I'm incredibly grateful to my parents for is the philosophy that they gave me of like, never spend more than you earn, i.e. like have a gap. Repay your credit card in full every month. Like I never thought of money that I spent on my credit card as mine. I never like looked at the limit and thought, oh, that's my money to spend. Like they instilled some really good stuff in me, and I think I'd rather it was that way round, and now I need to kind of free up a little bit than the reverse. What do you think?
Well, I think I just want to build on that. The key concept for me is what got you here won't get you there. And that I have to keep repeating to myself, like the things that got me to success level A in my business are not going to get me to success level B, because that's what achieved those results. The things that got you to financial independence will not help you to enjoy financial independence in the same way.
Right.
And if you could instill that belief that the things that get them grades like that will not help them when they do this, the things that help them do this won't do that. And I don't know if you saw, I wrote an article called The Miserly Millionaire on the website that was about the exact thing you're talking about. Because we have met so many people in the FI world who will not spend their money, and they sacrifice happiness and health to accumulate more cash. And they have more than they could spend in 5 lifetimes. I'm like, what are you doing? And I find it crazy. So there is something really important to what you've just said, that we need to talk about that. Yeah, and Dominic put about the Tesla article that Mr. Money Mustache put. Like, that was his most controversial article. I spoke to him just afterwards. His most controversial article to date, because everyone who's on their way to financial independence thinks it's hideous. And then everyone who's got to financial independence goes, yeah, I really struggle with spending money too. And it's that concept of what got you here won't get you there. So if we can find a way to help your kids, Christina, the two of them, to understand that the thing that creates success, because what happens is we get success in one area of our life and we go, okay, this equals success, therefore I will do this in every area of my life. And that's how the brain works. The brain links pleasure to the action you were doing when you got the pleasure and goes, that's the route to pleasure, I will keep repeating it. And then you are stuck doing that one thing for the rest of your life.
Also,
So,
you've made up a story that was the thing that got you there.
Yes.
As well.
Quite often it's not.
Yeah, so I was like quite stressy in my job and my career, and I'm like, I've got to work hard, I've got to do this, I've got to do that. And like, I then equate like, oh, stressing equals doing well somehow, and then applying that to all areas of my life, including let me tick off all these fun things I've been doing. Like, it doesn't work. So yeah, it's like your brain attaches.
Katie stressed her way through the first year of our retirement.
Yes.
Yes. So thank you. That's so helpful. And I think it comes down to delayed gratification, right? We're taking this and setting it aside and investing it so that we can spend it. We can spend it later and enjoy it. So
yes.
Okay, you helped me so much. Thank you. Thank you for everything. You guys are phenomenal.
Oh,
Thanks
Christina,
for
thank you for your
positivity.
comments and everything. You're amazing. Awesome. Bye to here. Thank you, Christina. Okay. Next up, we have Nick. Nick, you look like you're in a large sauna.
Look after yourself, mate.
Oh, we've got a little bit of movement. People sneaking out from the live. Hi, Pete. From the
Take
live
it easy. Love the t-shirt.
audience. So forgive the slight
Yes.
interruption.
Asked to
Nick.
unmute. Nick, can you unmute? And are you?
Yeah, I can
actually-
unmute. Yeah.
Are
I
you
wish
in a
it was
giant sauna?
It's got a bit chilly in here now. No, first of all, I just want to say a massive thank you for this course. I mean, this course last year, I could take up loads of your time to tell you the amount of things that I've changed over this last year, but there's been a lot and it's been really, really helpful. But I think for me, one of the highlights or one of the things that's been really, really helpful was that whole idea of just building up an emergency fund, which was really useful because actually earlier this year, I was working for a small startup and we went bust, unfortunately, and I was made redundant. And it was interesting because we knew for about 2 months before we went bust that it wasn't looking good, and we were needing to get funding for this for the business. So basically, over that 2-month period, as we're all there trying to get the funds in and whatnot, which obviously failed, it was interesting to see my colleagues where they were all so worried about their personal finances and what they're going to do and commitments and that type of thing. Whereas, I was quietly absolutely fine in terms of I was just completely peaceful about it all because I knew I had money to fall back on, and actually if I was going to be out, I could afford to be out of work for a few months if needs be. So thank you very much for my own mental health with all of that. But I've also found I've become a bit of a Rebel Finance School evangelist, and that I just can't stop telling people about it, much to my wife's annoyance.
Yes, I know.
Thank you.
I know that phase. I also went through it, and I was like, "Did you know you can like sort your finances out, and then you can just like be free and live your life?" And they're like, "You're weird." So I can relate.
Yes.
Yeah.
But thank you for spreading the message.
No, absolutely. But my question is actually, I do have a question. In that I've now joined a fantastic new small business. I've been involved in the company now for just over 2 months. There's one problem with it though. They have nest pensions. And yeah, when I found that out, my heart dropped. I was like, "Oh, are you kidding me?" And I've had a nest pension previously, which was just rubbish. And so I had, from the course last year, my pension's all looking lovely with Vanguard and whatnot. But anyhow, I've had a good chat with the managing director because he's similar age to me. And I basically just shared with him a few kind of stats and a few bits and pieces about how things could be different if we were to invest elsewhere. And he has basically said, look, if you can give me some useful information in terms of where else we could invest, he goes, I'm open to changing the business. I mean, there's only 10 of us employees. And so I was just wondering if, and I don't know whether other people in the group here might have ideas as well, but in terms of kind of pension schemes with SIPs like Vanguard, you can't have an employee pay into it, which is quite annoying. But in terms of pension schemes out there, if there's any good ones that do index funds, the only one which I can find which seems to have index funds is Smart Pension, but it's not the Vanguard ones. It's just the I suppose different index funds which look quite similar in terms of where it's invested. But yeah, just wondering if you know of any others which are not nest.
So
firstly, Nick, I want to say congratulations for the emergency fund and the changes that you made. That's awesome.
Thank you.
Secondly, as you were speaking, I was like, oh, Nick should go and like talk. It's a small company, sure, like you can go and talk to people and say, can we change this? So like,
and you've done it.
being
Amazing.
proactive rather than accepting like, oh, it's nest, oh, never mind. Like you've actually gone and trying to do something about it. So I want to encourage everyone listening as well to feel that you can do that, even if you work for a really big company. Like if enough people say, hang on, this isn't right, like you can change things. And we said yesterday on the course, didn't we, like everything is negotiable. So like if you don't like something, change it and do something about it. So like I commend you, Nick, for that.
I have thoughts on the actual thing because we went through this process. So I set up our company pension scheme at Rebel with 12 or 13, 12.
This is with Rebel Business School.
Rebel Business School
from Rebel Finance School. So
Rebel Business School.
Yeah.
I set up the company pension and I went through the whole list and I couldn't find anything that had a decent broad-based index fund in the government approved pension schemes.
Like the auto-enrollment.
The auto-enrollment stuff. I'm like, what are they doing? And I was like destroyed by that, thinking I can't put in good conscience the people that work with me into that kind of crap. I just can't do it. There was only 4 or 5 of us at that time. So actually what I did was set up a nest pension, and then I told people it was there, explained nest to them and said, you could opt out and we will still contribute to your SIP. That's what I said to people. Yeah. And funnily enough, everyone opted out and they all opened Halifax SIPs, which allows you to make employer contributions, not automated, but we do it once a year. We pay the company contributions out once a year, so it's easy, and it goes straight to, so every team member that has worked here, I think there's one that stayed in it, but that's one of the new members of staff, but everyone else has opted out, and that's how I did it, because I couldn't find a good solution. And maybe there is now, because this was a few years ago, but I couldn't find a good one, and I went through that process. So we went through that thing of like, what do we actually do? And as an employer, I actually cared about the people who worked for me. So we had a chat, and they decided on their own that they were opting out.
It's a bit fiddly and tricky, isn't it? Because it's not like you can do a matched contribution that way, or it's not like you can police and say, oh, if we put in X% and they put in X%. So that's a bit harder. And I think we keep encouraging the people at Rebel to say, look, you can please also be contributing as well. So like, as you go down this route, I'd say, is that something to like mention to your colleagues? Make sure you contribute as well, if it is that way that you go. Yeah.
Thank you.
Yes, and just to build on that, Vicky asked at the same time, Nick, my workplace pension is with Aviva. I asked if there was any other option or they would pay directly into my SIP, but sadly not. Can I transfer into my Vanguard once a year with the same process as moving my previous pension? I think with Aviva, you can do part transfers. With Nest, you sadly cannot.
Okay.
You can't transfer out until your employer has stopped paying into it. But with other pensions, you can. So I just wanted to highlight that. Does that help at all, Nick?
Yeah, that's really helpful. No, thank you very much for that. That's good. And yeah, I mean, I would chat further with our managing director about that. But actually, you know, in terms of paying once a year to Halifax, that could be a really good potential option as well. So no, thank you for that. And yeah, I'll see how that goes. But thank you so much.
Let us know how you get on. Thank you,
Yeah,
Nick.
will do. Thank you. Appreciate it. Thank you.
Awesome.
Before we go to the next question, let's on Zoom, let's pick off some of the other questions we had through on email. So I mentioned a bit earlier, we had an email from Claire saying, how do I inspire my partner to take an interest in this stuff? And we get this question so often. It's like, I'm really into this stuff and I've been in Rebel Finance School and I'm really passionate about this. And like, my partner just doesn't seem to come along with me. She said, neither of us are any good with our finances. I've been trying to make this a family thing for the past 2 years, but he's just not interested. Alan, I think you wrote a really good article about this and taking through the steps that you do. So it's always about starting with the big vision, the big pictures to like, why are we doing this? No one cares about
tracking numbers or doing monthly finance meetings.
I think I'm an exception in that case, but like, I'm like, yes, the numbers, the detail, but like most people like don't care or they feel like you're going to try and control them in some way. So I think it's about coming up with a shared vision of where you want your life to be, not just in finances, but like in all areas of your life. And Alan wrote this article that goes step by step through, and we also had a video as well that covers similar things. So I'll put that in the chat now, and we'll also put it in the YouTube description later on. Did you have anything to add on that? Oh, hold on. Let's give you the microphone.
No, it's just that I started making really colorful Excels.
You made really colorful Excels. Did that help?
Well, at least for me, for myself.
I love that. Really colorful Excels. I'm always like, well, like put the numbers on a PowerPoint with pictures or display them in a way that your partner might be interested.
Do a little dance.
Yeah, do it at a breakfast thing. Make them food, like make it pleasurable in some kind of a way. Have fun. Someone put in the chat earlier, we should have an online Settlers of Catan finance meeting. I think that's amazing. Let's all play board games and then do the finance meeting afterwards. But like, make it fun. Finances can be fun. It does not have to be dull. We've just got to find a way to make it pleasurable. And I think if you do start right at the top with what's your vision for your life, and then you go, okay, you want to do X, let's make that happen. How much do we need to do that? What do we need to save to create the life you want? Then the numbers have a purpose. We're not just doing numbers for the sake of numbers, although I know some people who do like doing numbers for the sake of numbers.
What are you pointing at?
Move on.
We'll go to Billy, who sent an email, and then we'll go to Gary on Zoom after that.
He's waiting very patiently.
He's a very patient chap, isn't he? He looks very nice. Anyway, Billy said they have a emergency services, retired with a really nice emergency service pension, maxed out both my wife's and my own stocks and shares ISA for this year with Vanguard. I've put money into a fixed interest deposit account as the interest is higher, but is this the best place to be putting this extra money, or is there somewhere better? So I guess like a few questions to kind of come up a level. Firstly is like, what is this money for? Is this money that you're investing? Is this money that's your emergency fund? Is this money that's for spending? If you're retired, is this like your money for the next year?
Or is it what you're going to actually live off? So you're actually investing it for the long term and you're going to live off 4% a year? Because it depends what the money's for. You can't really answer that question without knowing like what it is.
So if it's cash that you want to be spending in the next year or so, I would say like maybe think about putting it in premium bonds. If it is UK, isn't it? It's ISA. So yeah, premium bonds. If it's money that you want to invest, then you have the SIP option, which you can still pay into up till 75, and then after that I think it's just under £3,000 that you can do per year, isn't it?
Yes.
Yeah.
We say avoid taxable accounts, like use up your ISA and your SIP allowance first. But if you've used those both up and you're very successful, then it's still better to have it in a taxable account than just earning interest. Like, it is still better to invest it. We have money in a taxable account. We don't like getting taxed at both ends, but we earned more in those few years than we could put in SIPs and ISAs. So we put it in a taxable account, and every year we sell off part of what's in the taxable account and put it into the ISA. So we kind of sell a bit off, put it into the ISA, sell a bit off, put it into the ISA, and gradually we move that money that we made into tax advantage accounts. So it's better to have it invested than not to have it invested. We have a question in the room. Please, can you pass the microphone back?
And then you're next, Gary. You patient man.
Hello.
Hold it right by your mouth, please, Tony.
Yeah, sorry, just on that one. I've got a couple of others, but do you have, in the taxable one, do you have it, say, in an ETF so that you can convert that quickly into cash to put straight into the ISA, or do you have it in an index fund in there, which takes 3 or 4 days to clear, and then how do you do that? Second,
if we answer that question first? So
if we were wise, we would have done it in an ETF, but we weren't. We did it in an index fund, which takes a few more days.
One of the advantages of an ETF, exchange traded fund, is that you can buy and sell pretty much instantaneously, whereas, as Tony rightly says, the index fund, it takes a few days. So yeah, it's not ideal because you're out of the market for a few days, and normally the market on average is going up. So more often than not, you're going to lose because you're buying at a lower price and selling at a lower price and buying at a higher price when you move things between the accounts.
I had to learn that one myself the hard way. But other one was, I didn't quite catch it before, but was the point made by the other gentleman in the sauna, was that that Vanguard doesn't take employer contributions. Did he say that?
Only if you're a director of the company. So if you are a director and an owner of the company, you can pay into your own director's pension. But if you've got staff, team members, you can't pay from your company into their SIPs. They just haven't set up the infrastructure yet. They've only had a SIP open for a couple of years.
I think there's something they're planning on doing.
It's something they're planning on doing, but
who knows when.
They're still getting to it.
Do you have like a joint ISA with Halifax? Because Vanguard doesn't do it. Do you have
ISA?
Or as in between the two of us?
Yes.
I don't think there's such a thing, is there?
We had one in one of the ones that we ditched because they were managed, but
it would still have been in your separate names, I think.
Okay.
Yeah, because you have to have a government. You have an allowance from the government of 20 grand a year, so they want to know it's per person.
Okay.
But we have separate ISAs with Halifax.
Yeah.
Because we think of our money as
one.
ours. We actually don't have any joint accounts, but we think of it in aggregate. So Alan's got his ISA, his SIP, his taxable.
I think you're probably right. Yeah. In hindsight now. And finally, because you guys are anti-property, anti-iPhone, I just wondered if you're anti-insurance as well. Yeah. Like, do you have any insurances? Like, obviously, you'd think about travel insurance as being one of your key things.
We have travel insurance.
Yeah.
I think just as a summary,
life insurance, all of those things.
Yeah, coming up a level, insurance is to protect you against certain risks. So people think, well, do I need income protection insurance? Meaning I need to protect myself from the risk of losing my job. Well, if you have an emergency fund and you started to invest in things like or the risk, they have critical illness insurance. If you get a certain horrible disease, basically, you get a payout. Well, it's like, well, we don't need to do that because we have enough money to be okay. But it's about thinking about those risks.
We do have travel insurance.
We definitely have travel insurance
because shit goes wrong, stuff happens. That's actually a critically important one for us traveling around the world. But it's always like, what is the risk you're protecting yourself against? We don't have kids, so it's not like if we died, we need to fix something for them, so we don't need to insure for that.
Hmm.
If I die, like Katie is not dependent on me. She actually like earned more money faster than I did. She's fine. So like you don't need to protect my income or vice versa.
And actually, obviously it's different now that we have enough to live for the rest of our lives. But even when we were working, we thought about this process. It's like, okay, we don't have any dependents. We like even each other because we're both capable of earning good money. It really depends on your circumstances. It's like, okay, you know, in a very traditional family, you'd have a couple and the children, and one person may be looking after the kids and one person earns more money, and you think, okay, if the breadwinner, the one earning lots of money, something's to happen to them, how would we cope? What would we do? And insurance is one solution to that. There's also thinking of like contingency, like what actually would you do, and sit through and think about the plan, because whilst you're paying out insurance premiums, that's money that you could have been investing, and some types of insurance are quite expensive depending what it is. So
I do not have iPhone insurance.
No.
I like self-insure for my iPhone or my laptop, and like those things are mostly a waste of money if you're good at looking after your stuff. If you're not, and you throw your iPhone in the toilet every week, then get the insurance.
Yeah, so it just comes back to, what are you trying to protect against? Do you need that?
Yeah. Did that help at all?
Yeah, I'm going through that process of trying to think what it actually is. And you guys are in a good situation, I suppose. You don't have any sort of property to insure. You don't have sort of
we are keyless
dependence and that sort of thing. But, you know, you got to think about all these things when you're sitting in that sort of situation.
Yeah.
But anyway, thanks for that. Sorry to hog the mic.
No, it's a
Thanks,
pleasure.
Tony. We'll
Can
go
we
to Gary because
do
he's
Gary,
the
and
most
then we'll
patient
come
man
back
in
to
the
the
world.
next
We'll come
one.
back to Sarah.
And just a question on the chat. Anyone got info on SIPs and opening one, says Billy. We've done a video, Billy. We recorded it last week. It will be up in the next few days, which will guide you completely through opening a SIP. So it'll be a step-by-step how to do it. That is coming this week. So subscribe to the YouTube channel.
Also, I think that's quite a broad question. Anyone got info on SIPs? So that might mean like, what is a SIP?
Course.
How does it work? Like, Billy, I don't know if you came to the course last year, or you're very welcome to come along this year. Yesterday was week.
Next week we're doing
exactly.
SIPs.
Next week is all about SIPs and ISAs and how do you practically get started. So anyone that wants or needs a refresher, please come along to that. And they're on YouTube catch up as well. So if you can't make it live, then you can watch at your leisure.
Gary, are you able to unmute and talk to us?
Hello.
Hello, Gary.
How's things?
Nice to meet you.
Yeah, you too. Just before I ask a few questions, if that's okay, just a big thank you for what you guys are offering. I've learned a lot. I'm actually on this year's course as well as last year's, and I've seen the tweaks you've made, and they're fantastic. And
thank you.
Yeah, long may it continue.
Thank you.
Yeah,
That's
we
awesome.
enjoyed
I'm glad
doing
you've noticed the differences.
The tweaks and the twerks.
Yeah, for the better. Definitely more polished. Fantastic. But I've learned. I keep on learning from this year and last year. It's every day's a school day, and there's always more to learn. So
yeah,
no,
so do we.
Fantastic. You're national treasures, definitely.
Oh, thank you.
Continue, please continue. Yeah. So before I go into a couple of questions or where I'm at, a bit like yourselves, I'm big into the property, but I don't want to be anymore. So I'm a buy-to-let landlord, and you can say I've seen the light, but I'm basically selling them off. And quite a big portfolio. I just don't want to be a landlord anymore. The government don't want landlords in the UK. I think we all know that. We're getting taxed. It's just getting harder and harder. They're screwing us down further and further. And basically, as a business model, it doesn't really make much sense anymore when I do the numbers. So I'm looking at a more passive way to invest, and property isn't that. And I got a strategy to sell them off due to CGT, capital gains tax. But obviously, I know that there's implications coming the other end as well, such as EPC regulations. I'm averaging 2 a year to sell off. That means I'm going to have very cash heavy, and it's more than what my SIP allowance will be per year. It'll be more than what my ISA is and my partner's ISA. So my question is, I think I know the answer, but where should I then put that excess money? Is it in a GIA? What are your opinions on that? I know it's not advice, but what are your opinions?
GIA, just to help everyone understand, general investment account, also called a trading account, taxable account. It's the other option for how to buy a unit, index funds after you've used up your other allowances in the other two.
Yes, we actually did that. So we sold our properties and we had a whole chunk of cash come in, and it's like, well, what do you do with it? We maxed out the SIPs and the ISAs, and then we put it in the general investment account. And then, like, after you've gone through, you've got a multi-year strategy coming up, and we only had 2 investment properties and 1 we lived in, so we only had 3 to sell. But it was like a multi-year strategy of selling them off, taking the money out, putting it into general accounts, and then you've got the strategy afterwards of slowly moving it from the general account to the ISA to the SIP. So you could be looking at a 10 or 15-year plan to slowly move that money around, but that's just the game you end up playing.
Yeah,
and because it's so long, you must have it invested whilst you're doing it. You can't, like, leaving that in cash for that long whilst you're doing it will slaughter you with interest rates, not interest rates, inflation.
A really good point about the way that you invest it in the taxable account, because you're going to be wanting to move it over probably like instantaneously, as close as you can. But if you were to go exchange traded funds as opposed to index funds, that would allow you to do that. So just to backtrack to explain what the difference is. So exchange traded funds is kind of index funds that are traded on the stock exchange itself. So with stocks and shares, you can buy them like at
instantly,
any point during the day, whereas with an index fund, they're priced once a day. You have to like sort of apply to get your money out, and it takes a couple of days to get it out. Which
is normally not a problem because you left it in there for a long time.
And then it takes a few days to then get it back in. So as Tony rightly said, you're potentially had your money out for a few days. So when it does come to investing your like exchange traded funds, I think it's a good way to go.
Account.
We're normally like, well, why would you need to be able to do it immediately? Like,
actually, we don't want people to get it out quickly. It's like you should be leaving it there over the long term and just living off a tiny amount.
Where was Tony when we were doing this?
I know, Tony, you could have helped us years ago. Why didn't you set up a course to teach us? Bitter experience.
So on the
oh, hold on, we can't hear you, Dom.
Yes. So Dom just said the words bed and ISA. That's where you sell off. Yeah, Gary's nodding. It's where you sell off what's in your taxable account and put it into your ISA. It's just the technical term.
They do it instantly.
Oh, they do it instantly. Oh, because you've got it in. Yeah, if you have it with the same provider, they do it instantly.
So you're not out of the market, are you? That's the concept, isn't it?
Sorry, Gary.
Sorry, just on the GIAs, or sorry, general investments. You've got, and I think it applies to SIPs and ISAs as well. You've got income, you've got accumulation. Am I right in saying for GIA specifically, this is for tax reporting, you're better being in an income because the paperwork is easier? I've heard that accumulation, it's a nightmare to report when you do your self-assessment. I'm actually self-employed, so I'm a contractor. I'm an engineer, so I run as a limited company, so it's the least work I can give my accountant, the better. And they're saying to me, go through the income route, not the accumulation. Is that?
Yeah, because so the way it works with the tax on the general investment account, the one that you would use after you've used up your ISA and your SIP, is that even though you have an accumulation unit and you're not actually receiving the dividend like in cash, you're still liable for the tax on it.
Yeah.
So you're right, it's an absolute pain to
it
do.
bakes your brain. We have literally been sat with spreadsheets trying to work that out.
I'm quite good with spreadsheets, and it takes us like a long time.
And then the accountant then
sent one back saying you made a mistake. So like, yeah, it can be quite complex because you're buying at various points, selling at various points. You know, as you get your funds through from selling your property, you're going to buy at like different points, and then you'll sell it, and like, yeah.
Yes, so they're probably right. It's not ideal because you'd ideally just have it auto invested, but it's probably right. It does save you. We haven't done it. We've just put up with the pain of the paperwork.
Yeah, we've made 2 mistakes there, haven't we?
Yeah.
Sorry, a couple more questions. Be really greedy. Apologies. The FI number. So I'm on a path to FI. I'm planning to be fully FI'd in 5 years. Hopefully, that's the trajectory anyway.
Nice.
I get the 4% rule, but so this you take your how much do I need to live off, multiply by 25, and you take off 4%, the inverse of that. I get all of that. The question is, that pot that you calculated, how long should it last with a 4% rule? Is it 30 years or 25 or what?
So the study that they did was for 30 years, wasn't it?
30.
Yeah, the study was based on success or failure over a 30-year retirement.
Okay.
However, like, it didn't just end at that 30 years. Like, the study did, but life doesn't. And the interesting thing about that study, it was, if you were 100% stocks and shares and you lived off it for 30 years, and they had the stereotypical example of $1 million invested, live off 40 grand a year for 30 years. What do you think the average person had left at the end of 30 years if they spent 40 grand a year, inflation adjusted, and just like, that's what they did? What did the average person have left at the end of 30 years? Does anyone know?
I know.
Judith says 2 million. Gary's like got a slightly upside down smile that says he's thinking. Does anyone else know? Chris Andrews says shitloads.
An upside down smile, do you mean a frown?
Derek says something like 7 million. It was 10.75 was
Sally
the,
got it.
yeah,
Lump
10
sum
million.
Sally
Says,
got it. 10 million.
so like, your chances of being ridiculously wealthy after a 30-year retirement of spending all that money is really high. And there's quite a lot of movement in the financial independence world that 4% is quite low, and 5% like could easily be sustained. But we're all quite risk averse, and we don't want to get to 90 and have nothing, so we keep it at 4. But for us, we retired when I was 40 and Katie was 35. I hope I live beyond 30 years because that would make me 70. I hope I make it a bit longer than that.
Me too.
And I'm kind of fine with the risk. And having seen like what it's grown to in the first 4 years since retirement, I'm like, okay, we're going to be fine. So I think like, for me, you will be fine. It's based on 30 years, but I'm pretty sure it works for multiple generations, not just 30 years.
Ooh, thanks for clarifying. Final question. I asked a question in the chat before about the having FTSE all cap and the developed world ex-UK. I have both in my SIP, and I'll tell you the reasons why. I started off the opposite of you. I was all cap all in, and I was driven by the fees. Like, oh, that's 0.09% cheaper. Oh, let's buy a bit of that. I'm fully aware that it's 70% common, but you can't lie. Fees are over time. Fees eat away your wealth. There's no question about that. My question is, I'm not a big believer in emerging markets, any cap or small cap develop, and that's why I like the developed world ex-UK. I don't really believe in the UK either. So in an ideal world, sorry for people who I live in Ireland, so. If I was to go for developed world ex-UK and sell the global all cap, that means I'm going to spend time out of the market for maybe a few days.
No, don't. I wouldn't.
Because I am.
Oh, you. What do you mean?
Sorry, my question is, if I was to go for just one, my inkling is just to go for developed world ex-UK, and ditch the all cap. But it means selling the all cap. I'm going to be out to the market for a few days while I do that.
That's what I'm
I have to
saying.
sell before I reinvest.
I would just stick with what you had and then make a decision for which one you're going to do going
in
forwards.
the future.
There's like,
right, okay.
I wouldn't personally do that. I would just stick
if it's
with
in
what
an
I've
ISA, there's no tax implications
no
either.
tax.
If it's outside that,
It's
then
just
there are.
It's a SIP.
It's a sizable.
It's a SIP,
It's a
okay.
sizable chunk as well potentially. Then you don't really want that out for too long.
No,
So I would just leave, like, I would just
do the future
I know
decisions.
I know it's not like clean and neat, and I like that would potentially bother me as well. But like, I would just
I'm a bit OCD like that.
yeah, like, but are you willing to potentially?
Are you
like,
willing to
lose out?
pay
Yeah.
for keeping it clean and neat? I guess is the question.
Yeah. Okay. All right.
I wouldn't pay.
I
I'd be
wouldn't, I
like,
would
I'd
just
put
leave it.
up for it. Yeah.
Which is a big growth moment for me.
It's a big growth moment.
Thanks, guys.
Thanks,
Thanks, Gary. It was lovely to see you.
So we're going to
appreciate it. Thank you.
Yeah, got that. Thanks, Judith. Sarah, we'll come to you next after I just cover this one from Tracy on YouTube. So Tracy said, how did you both decide when to fire? So FIRE stands for Financial Independence, Retire Early, meaning when did we decide to quit our jobs, I guess. And there's kind of two sides to that. I don't know if you're asking, you know, when we knew we had enough money, or kind of psychologically willing
We'll
away
start
to
with
step
when you
from
quit your job.
When did I quit my job? Feels like a while ago now. I quit my corporate job in 2017. I was a contractor, and every time, like, I had contracts for maybe like 6 months in, and then it would get renewed, and I'd do a different project for 5 months, and then 3 months. And every time it got renewed, I thought, wouldn't it be really cool if I didn't get renewed and like could go and do something else? And then it happened. My first instinct was to cry, because that's what I do. And then I thought, well, I can now go and help Alan out with his business, with Rebel Business School. So I went and helped them for about 18 months or so.
Because at that stage, we
Yeah.
had 850 grand invested, and our target was $1 million. So we weren't quite there. So Katie didn't go back to work, and then she came to me and said, let's go traveling. And I'm like, well, we're not quite at the figures yet. I need to work a bit longer to get there. And I was fine with that because I loved what I did. So it was no issue. Obviously, I would have liked to have gone traveling. So then we worked, Katie was like, well, I don't want to go traveling on my own, so I'll work with you for a bit. So we worked together, we got to $1 million. And actually we took this mini retirement to go to America, and Katie learnt guitar, and I wrote a movie script. We took 2 months off to do that. And on the plane on the way home, we worked out that we were wealthier than when we left, having not worked and spent more money living in Santa Monica on the beach by the pier than I'd ever spent in my life. It was hugely pricey, and we were worth more on the way home than when we left. And I thought this was ridiculous. It's like, well, okay, why are we going home? I didn't understand it. So I went back to my business partner, and we just that's it. I've hit financial independence. Thanks very much. I'll still stay in touch. Obviously, we'll have a coffee, but I want to go traveling. And that was the real moment that made us go, okay, this actually works. Our index funds are worth more coming home after spending a lot of money than they were when we left. So that's it. Let's do this thing. Let's go traveling. And then we left, and we've been traveling for 4 years ever since. Nearly 5. Yeah. Okay. Question in the room.
Sarah.
Thank you. I got two.
Please keep the microphone really
to my mouth. Sorry. Okay. So I have what you've called a defined benefit pension, because I've got a teacher's pension, and that will pay me a lump sum, which I understand I can take when I'm 55, which is in 4 years' time. Would you? So we've established that these are not invested; they're recycled money. I'm understanding it as.
I think that's how it works.
I believe that's how it works. That's what my understanding is.
Okay.
Would you recommend that I take that at 55 and go and invest it in Vanguard, or I mean, they're said to be good pensions on the whole. Teachers' pensions are understand to be quite good, but good in the scheme of what I don't really know, and I'm still I realise, having reviewed your form, how nervous I am still. But would that be a sensible step? Could I do more with that by investing it in a Vanguard account than I could by leaving it sitting there?
Well, I guess the question is, if you leave it sitting there, because sometimes these pensions go, if you take the lump sum, you get the lump sum and you get X. If you leave it there longer, you get a bigger amount. So is that how it works for you in that pension?
I believe so. It will keep, well, as long as I'm in teaching, which I don't know how much longer I can survive, to be quite honest. Well, since your course, I've now been tracking it every month, whereas previously I hadn't looked at it for about 10 years. So it does seem to increase each month. I mean, not hugely, but it is getting bigger each month. So presumably as long as I stay in teaching, it will continue to grow. But I understand that from 55, I could take it.
So that
This is a maths question with a spreadsheet.
They're giving you a lump sum rather than giving you a defined amount for the.
Well, I get both. I get a defined amount. I get a monthly payment, and a lump sum, one lump sum straight off.
And that's how it works. It's not like you've elect to have.
No. That's how teachers' pensions work.
Okay, so you're saying what to do with the lump sum?
Would it be wiser to take that out of that system and put it and invest it in one of your Vanguard?
I mean, if it's just sat there in cash doing nothing, then yeah.
We would invest it in a Vanguard index fund and then live off 4% of the total figure. That's what we would do.
I assume since it's in I guess it's a lump sum. Is that like the tax-free element?
It'd be the tax-free.
I suppose so.
Yeah.
Okay.
I guess so.
Because I think we need to understand more about how it works, and maybe
it's like step one. Let's get super clear with. They must have an advice service for teacher pensions. So I'd get super clear on exactly the rules and the regulations.
Even starting, just get the paperwork and we can help you to read through it and understand. Yeah, I think even before asking for help, it's let's get all the paperwork that we can and have a read through, and also.
I'm a big one for just asking and they'll tell you, but Katie will read all the documents. I will ask a human.
Well, yeah, I would.
Two different approaches.
I would rather ask a human, but sometimes
do both.
Sometimes they're helpful. And the last question I gave them, didn't help me at all.
Okay,
but,
so maybe we do both, and then I think this next step for me would be going to a spreadsheet, and then just drawing out the years I'm alive, and when I get the different amounts of money, and then. I can see you breathing deeply now going, I'm not a fan of spreadsheets.
I can't even use I can use your spreadsheet that you've given, the net worth tracker, but I don't really know how to use a spreadsheet.
Do you have a friend that can help you with spreadsheets?
Maybe, yeah.
Or a young person?
Yeah.
Do you teach someone that's
Yeah, I do actually, yeah.
We did a workshop called Forecasting Your Financial Future, which shows you how to design a spreadsheet that charts out the money for the rest of your life. So you can see if I put my lump sum there and it grows at X, what will it be worth after so many years? And if I do this, what do I have here? And I would go through that and I would just lay it all out. And I'm not super geeky on spreadsheets. But I really enjoy it. But I would just look at what would my money do over the years, and that then gives me the confidence to go, okay, if I do this, I'm probably going to be okay until X years.
So just adding to that, I think there's been a few bits of stuff in the chat that people with similar situation, they're saying they think it's either take the 25 tax-free lump sum or leave it, it's not compulsory to take it. So I think it is understanding the different options and saying, if you choose not to take the lump sum, how much you would get, like Alan said.
Yeah,
and
Dee says if you take it early at 55, it will have a small reduction. Each year it will get better and the percentage will increase to 100%. But I think it's we need to understand the rules. Otherwise we're going to be making decisions based off chat, and we need to really understand the rules of that stuff, because it's quite a big decision to take that early, because it might cost you later.
Right. Okay.
And we can't really go too much further without.
No, I understand that. What's the question? What's the key question I should be asking them then?
What happens at age 55?
Right.
What are my options?
What are my options? Okay. What are my options at 55?
Yeah. And if I leave the 25% in, how much better am I off at 60, 65, 68? What happens to that? Because quite often it is this thing of you leave it in and you get more later. But then you have to work out whether that's good, whether you take it out, invest it, and then we need to do the calculations in the spreadsheet to go through the options. But it's always we come back to the maths. It's let's take the emotion out, look at the numbers, and then decide what's best for us on the maths.
Okay, all right, I'll ask that. The second thing was it's more of a reflection really, but having filled in your feedback form just now, well, I realised that one of the things interesting what you've done in the year since. Do I track my spending? And I've written down I record my spending. I don't necessarily think it's the same as track it. I record it each month, but I'm not going back each month and going, oh, I spent this much on food and more or less than last year or last month, whatever. But as a reflection, I would say I found this process quite isolating. I'm a single person. I don't have attachments, dependents. So I don't have someone to have a monthly financial conversation with. So I haven't done that monthly catch up. I do my own tracker sheet every month. And I'm not on Facebook. I refuse to engage with Facebook. So I'm not in this community.
Can you see any other humans around you now that might?
Well, yes, I can. I know. It's interesting how many men here are this evening. I think that's really interesting. Wondering where all the women are. But I see one or two.
Just
clearly, there are.
On that question, 75% of people on the course this year are female.
Well, that's really interesting because I don't.
Let me just finish that one, if that's okay.
Yeah.
Like, it's really interesting. 70% of the people who've been on the course are female, and it has varied here every week depending on what it is. So I don't think we can take a summary of the 10 people in the room versus the.
No, I know. I'm just I'm
4 if you count
4.
Katie.
Anyway, we have people of all genders.
But yeah, I understand.
Yes, it was just an observation, not a.
No.
I'm not a statistician, quite clearly.
I understand that. I think
for me, it has been an isolating process, and I hear a lot about have a conversation with your partner, and I don't have that situation. So, and I suspect other people don't as well. But I'm it's a question I'm asking myself out loud. How do I make? Because you're saying make it be fun, enjoy the process, and I'm like, well, it's been really useful. It's been good for me to evaluate my circumstances, but I don't have an immediate person to engage that with. So, and that's down to me. And I do have critical illness cover because if something bad happens to me, then I've got to pay. How am I going to pay my mortgage?
That's a good decision.
I do have it.
Do you have any friends?
Yes, I do. I do have friends, but I don't see them in similar circumstances, which is why I haven't. Yeah, I have lots of friends. Yeah. But
is there someone that you could connect with over this, or start the conversation at least around money? Because I know it can be a taboo subject, and maybe you don't
go straight in with the "Do you want to share financial meetings?" Although we have done that with friends. But it's really starting the conversation. We are unusual, but it's definitely starting the conversation with cash. And I don't think it's please take this in the right way. It's meant with care and to help. I don't think it's the process that's isolated you. I think it's you're going, I have to do it on my own, and not actually sharing it with other people. You've chosen, and I'm not telling you to be, but you've chosen not to be on Facebook. You've chosen a path that has meant you have that experience. What I'm suggesting is you choose a different path and speak to friends, speak to other people, find some strangers. I would, in the chat on the calls, if you don't go into the Facebook group, that's cool. But the Zoom chat on the calls, maybe you can message the people on that. If you come to this year's course, there's hundreds of people in there, and you could say, I'm in this area. Does anyone want to share a monthly finance meeting? We've actually done our last 2 monthly finance meetings with a group in London. We've started doing the meetups, and we're trying to end that for everyone to create that.
SRF says, want to talk with me, also single woman, on the Zoom chat. Thanks, SRF.
Thanks,
maybe,
SRF.
If you could both email us at finance@therebelschool.com, and we can put you in touch if that's something that you're interested in.
Yes, and Ellie Stevenson says there are women online. Bibiana says we are here. So there are people shouting out who want to help, and if you feel isolated, it's really important to reach out and tell us. And I'm so glad you told us so that we can have this chat. And then anyone on the chat, hopefully feeling the same way, they'll start to reach out, and then we'll end that for all of us, because I think it's so important.
No, thank you.
Dom had a question.
I was going to say, if you go on meetup.com, there is the London FI group, which is pretty good. And there's also a Manchester one, I think.
Okay, cool.
Where do you live, Sarah? Yeah, London. Sarah lives in London. Okay, yeah, there's so much going on in London with this stuff. There was a question that I wanted to cover on. Sorry, Sarah,
You did. You did. You did. Thank you very much. Thank you.
Where was it?
We've got a
Viviana-
question just here from
I
Lee.
had okay, go ahead with that one.
So Lee asked, is it possible to figure out how much I would need to reach FI if I didn't want to leave large amounts of money when I die? I don't have anyone to leave anything to, and even if I did, it's mine and I earned it, so I'll spend it.
Yes, Lee.
Love it, Lee. Enjoy that cash. It's interesting because we don't have dependents. Like, I don't particularly need to leave large amounts of money to anyone, but you've got that balance. If you knew exactly when you were going to die, you could time it to the pound, but there lies the problem. You don't know when you're going to die. So you have to like have these reserves to get you so far to be able to do it. So
the 4% thing that we talked about as well, where you can live off 4% of your pot each year, that's considered like the safe withdrawal rate, the safe amount to take out, so that you don't run out. So is it so you don't run out, or so that you preserve it? So you don't run out.
So you don't run out.
Yeah,
so
you
that
don't run out.
96% of the time you do not run out of money. In 4% of the time, which the case, there was 2 times in history where you would have run out of money, which was the Great Depression and another one. But 96% of the time you don't run out of money. But this whole thing is based on you spend that money without ever looking at it. So all I would say to anyone is, if it looks like you're heading towards running out of money, spend less. If you look like you have a shed load of cash, spend more. That's the basic equation. And we will definitely be doing that going forwards. Like if ours goes up at 10% a year and we get to 60 and we have a lot of money, then we will absolutely be spending more to have more fun if we've got a good reason to spend more.
I think that's once we've got through the first few years, because there's a risk.
Sequence of returns
It's called
risk.
sequence of returns risk, meaning what are the returns in the first few years after you retire? And if you can survive those first few years, then like you're good. So I wouldn't kind of flex in the first few years, but beyond that you're good. But when it comes, there's so much debate as to what is a safe amount to take out. Some people say it's 3%, some people say it's 3.1%, some people say it's 3.721%. Like people get really geeky about this.
The guy who came out with the rule recently said it could be as much as 5%, so he's changed his mind. But it just, you do what you do. Someone said in the chat, read Die with Zero. There's an interesting book called Die with Zero.
I don't agree with some of his stuff. Some of his stuff is really good.
Yeah.
For instance, he says, oh, young people, they should spend a lot and go into debt even because, you know, earnings will always go up over your career. Well, not necessarily. Like if you have a good career and you have good advancement, like prospects of your career progression, then maybe, but something happens or you want to have a family, like it doesn't necessarily mean that. Like, yeah, I don't agree with that part of the book, but in general, I think the book's really good because it talks about living your life and using your money to have cool experiences, which is like, in my opinion, the whole point.
Yes.
I just wanted to cover something that Viviana said in the chat.
Hi, Viviana.
Viviana, she's always here. I love it. I think this was off the back of Nick in the sauna's question about what to do with the.
Love you, Nick.
The fact that with Vanguard, you can only have a SIP with them, have employer contributions to your SIP if you are a company director. So Bibiana said, so if someone becomes a director of their own limited company, they can pay into their SIP with Vanguard and get the extra
top up from the government.
Top up from the government. That's
you don't actually get a top up from the government.
You don't, because when you contribute from your limited company, it's before tax, so you don't pay any corporation tax on that amount. So there's nothing to give back because you haven't paid tax on it. Whereas if you make a personal contribution, it will normally, well, it will be from money that you've already paid income tax on, and that's what the government gives back, the income tax on that. Whereas with a contribution from your employer,
it reduces your employer's tax bill, which is awesome if you are said employer. Yes. So you're basically paying it into your own thing and avoiding that tax. It's amazing. It's wonderful. Yeah.
Have we won the party?
Was that okay, Bibiana?
I hope so. She's on YouTube, so let's check.
Okay.
Oh no, she's moved over to Zoom. Sorry.
She's here. Okay. Well, I think it's 10:16, and I don't want to keep Al awake too late.
Blame Al.
one thing I wanted to say to you all is you get to choose what kind of life you have. And that's the thing I always come back to, is that where you are right now is the sum of the decisions you've made up until this point. If you like it, good job. If you don't, that's cool, change it. And people always say to me, like, they complain about their job, and I'm like, well, let's focus on trying to find you something else. Or they say, I don't like where I live. And I'm like, well, you know, you can move. But it's almost like they're trapped where they live, or they're trapped doing what they do. And I would say to you, if you love where you are, awesome. If you don't, change it and find something you do love, because life is too short to spend time doing stuff that you hate. You create your life, take control of it, build a life you actually want to live, because that is the biggest reward you can imagine, is living the life you actually want to live. Because there's this movement of self-care. We have to have self-care, so I will have a bubble bath and eat chocolate. Self-care is not bubble bath and chocolates or spa days. Self-care is building a life you do not want to run from. Self-care is building a life you wake up excited to live every day. That is true self-care, not one you have to run from to go into the bubble bath. One that you actually want to live, and you feel like at the end of the day, I'm losing because I'm tired. I wish I had more energy. I wish I was awake to be able to do more because I love what I do. So I wanted to say to everyone on Rebel Finance School, that's the secret purpose of all of this, is to help you get the life you actually want to live. I don't know what that is. Only you know what life you want to live. That's the secret purpose. So please use finances as a tool to create the life you actually want to live. Do you have anything to add, Katie, before we release everyone unto the night?
I do not.
Excellent. Thank you so much for tuning in. Derek from Scotland, Bibiana, Nick from the sauna,
Julie from Lake Como, who is no longer in Lake Como.
Sally May, Lump Sum Sally. Everyone is here.
Bye-bye, YouTubers.
Thank you
Thanks
so much for
watching.
coming.
Bye-bye, Zoomers.
And people in the live audience, we get to say goodbye to you after we say goodbye to everyone else. So goodbye online. Sally May, we love you. Bye. Bye, everyone. Abby Ninja is here.
Sally.
It's awesome. Right. We're actually going to leave. Good night, everyone. Thanks very much. See you soon.